Dividend investing, passive income and growth investing for beginners. Written by Daniel Shore. Narrated by Jacob Simmons. Chapter 1. Understanding Dividend Investing. Understanding dividend investing involves grasping several key concepts, which are the following. 1. Dividend yield. This is the ratio of annual dividends per share to the current share price. It's expressed as a percentage and indicates the return on investor can expect from dividends alone. 2. Dividend payout ratio. This ratio measures the percentage of a company's earnings paid out as dividends to shareholders. A lower payout ratio suggests the company retains more earnings for growth or emergencies, while a higher ratio indicates more of the earnings are being distributed to shareholders. 3. Dividend growth rate. This measures the annualized rate of growth in a company's dividends. Consistent dividend growth over time can be an indicator of a company's financial health and stability. 4. Dividend Reinvestment Plan, or DRIP or DRIP. DRIP allows shareholders to automatically reinvest their dividends to purchase additional shares of the company's stock, often at a discounted price. This can accelerate wealth accumulation through compounding. 5. Ex-dividend date. This is the date by which an investor must own shares in order to receive the upcoming dividend payment. If you purchase shares on or after this date, you won't receive the dividend for that period. 6. Tax implications. Dividends may be subject to different tax rates, depending on factors such as your country of residence and the type of account in which you hold the investment, e.g., taxable brokerage account versus tax-advantaged retirement account. Understanding these concepts can help investors evaluate dividend-paying stocks, build a diversified portfolio, and make informed decisions about their investment strategy. What are dividends? Dividends are payments made by a company to its shareholders as a portion of its earnings. They are typically distributed on a regular basis, often quarterly, although some companies may pay them annually or semi-annually. Dividends represent a reward for owning shares in the company and are usually paid in cash, although they can also be issued as additional shares of stock or other forms of property. Companies that pay dividends typically do so as a way to share their profits with shareholders and demonstrate financial stability. Why companies pay dividends? Companies pay dividends for several reasons. 1. Reward shareholders. Dividends are a way for companies to share their profits with shareholders, rewarding them for their investment in the company. This can help attract and retain investors who seek regular income from their investments. 2. Signal financial health. Regular dividend payments can be a sign of a company's financial health and stability. Companies that consistently pay dividends demonstrate to investors that they have steady earnings and cash flows, which can instill confidence in the company's future prospects. 3. Align interests. Paying dividends aligns the interests of shareholders with those of the company's management. Shareholders benefit directly from dividends, so they have an incentive to support decisions that contribute to the company's long-term success and profitability. 4. Attract investors. Dividend-paying stocks can be attractive to certain investors, such as retirees or income-oriented investors who prioritize regular income from their investments. By paying dividends, companies can attract these investors and potentially increase demand for their stock. 5. Tax considerations. In some cases, paying dividends may be more tax efficient for investors than other forms of compensations, such as capital gains. This can make dividend-paying stocks more appealing to certain investors from a tax perspective. Overall, companies pay dividends as a way to reward shareholders, signal financial strength, attract investors, and align the interests of shareholders with those of the company's management. Advantages and disadvantages of dividend investing. Advantages: steady income. Dividend investing provides a regular stream of income, which can be particularly attractive for investors seeking consistent cash flow. Financial stability. Companies that pay dividends often have stable earnings and cash flows, providing a level of financial stability to investors. Long-term growth potential. Reinvesting dividends can accelerate wealth accumulation through compounding, potentially leading to greater long-term returns. Diversification. Dividend-paying stocks span various sectors and industries, offering investors the opportunity to diversify their portfolios and reduce risk. Disadvantages. Potential for lower growth. Dividend-paying stocks may not experience as much growth potential as non-dividend-paying stocks, as companies may prioritize dividend payments over reinvesting profits for growth. Market dependency. Dividend payments are not guaranteed and can be influenced by factors such as economic conditions, company performance, and management decisions. Tax implications. Dividend income may be subject to taxes, which can reduce overall returns for investors depending on their tax situation. Limited pool of investments. Not all companies pay dividends, so dividend investors may have a limited pool of investment options compared to those who invest solely for growth. Chapter 2. Building your dividend portfolio. Building a dividend portfolio is a smart, long-term investment strategy. Start by researching and selecting stable, dividend-paying stocks from different sectors to diversify your portfolio. Consider factors like dividend yield, payout ratio, and dividend growth history. Regularly review and adjust your portfolio to maintain a balance between income generation and growth potential. Setting your investment goals. Setting clear investment goals is crucial for success. Begin by defining your objectives, whether they're long-term wealth accumulation, retirement planning, or funding a specific goal like buying a house. Assess your risk tolerance, time horizon, and financial situation. Once you have a clear vision, tailor your investment strategy accordingly, whether it's through stocks, bonds, real estate, or other assets. Regularly review and adjust your goals as your circumstances change. Assessing your risk tolerance. Assessing your risk tolerance involves understanding how comfortable you are with the possibility of losing money in your investments. Consider factors like your financial goals, investment time horizon, and personal feelings about risk. Are you more concerned with preserving capital or willing to take on higher risk for potentially higher returns? Various risk assessment tools and questionnaires can help you gauge your risk tolerance and determine an appropriate investment strategy. Choosing dividend stocks. Here's a more detailed expansion on choosing dividend stocks. 1. Strong fundamentals. Look for companies with solid financials, including healthy balance sheets, strong cash flow, and manageable debt levels. Companies with stable earnings and revenue growth are generally better positioned to sustain dividend payments over the long term. 2. Dividend yield. This is the ratio of annual dividends to the stock's current price. While a high dividend yield may seem attractive, be cautious of excessively high yields, as they could indicate an unsustainable dividend or a declining stock price. Instead, aim for a balance between yield and stability. 3. Payout ratio. This ratio measures the percentage of earnings that a company pays out in dividends. A lower payout ratio suggests that the company retains more earnings for future growth or to weather economic downturns. Generally, a payout ratio below 60% is considered healthy. 4. Dividend growth rate. Consistent dividend growth is a sign of a healthy company. Look for companies with a history of increasing dividends over time, as this indicates financial strength and management confidence in future earnings. 5. Business model and competitive advantage. Consider companies with a sustainable business model and a competitive advantage in their industry. Companies with strong brand recognition, intellectual property, or dominant market positions are better positioned to maintain and grow dividends. 6. Sector diversification. Diversify your dividend portfolio across different sectors to reduce risk. Industries like utilities and consumer staples typically offer stable dividends, while sectors like technology and healthcare may provide growth opportunities. 7. Dividend aristocrats and achievers. These are companies that have a history of consistently increasing dividends for a certain number of years, e.g., dividend aristocrats have increased dividends for at least 25 consecutive years. They can be a good starting point for identifying reliable dividend-paying stocks. 8. Financial health. Review the company's financial statements, earnings reports, and management commentary to assess its financial health and outlook. Look for signs of potential risks or challenges that could impact dividend payments. 9. Valuation. Pay attention to the stock's valuation relative to its peers and historical averages. A stock that is trading at a reasonable valuation compared to its earnings, growth prospects, and dividend yield may present a good investment opportunity. 10. Regular monitoring. Continuously monitor your dividend stocks and the overall market conditions. Economic and industry trends, changes in company fundamentals, and dividend policy changes can all affect your investment decisions. By considering these factors and conducting thorough research, you can build a well-rounded dividend portfolio that aligns with your investment goals and risk tolerance. Diversification strategies. Diversification is key to managing risk in your investment portfolio. Here are several strategies to achieve diversification. 1. Asset allocation. Allocate your investments across different asset classes such as stocks, bonds, real estate, and commodities. Each asset class has unique risk and return characteristics, so spreading your investments across them can help mitigate overall portfolio risk. 2. Sector diversification. Invest in companies across various sectors of the economy, such as technology, healthcare, consumer staples, and utilities. This helps reduce the impact of sector-specific risks on your portfolio. 3. Geographic diversification. Spread your investments across different geographic regions and countries. Economic and political factors can vary by region, so investing globally can help reduce exposure to country-specific risks. 4. Company size diversification. Invest in companies of different sizes, including large cap, mid cap, and small cap stocks. Each category has different risks and return characteristics, so diversifying across company sizes can help balance your portfolio. 5. Investment style diversification. Consider diversifying across different investment styles, such as value investing, growth investing, and income investing. Each style may perform differently in various market conditions, so diversifying your investment styles can help smooth out returns. 6. Number of investments. Increase the number of investments in your portfolio to spread risk. A well-diversified portfolio typically consists of a minimum number of individual securities to help mitigate the impact of any single investment's poor performance. 7. Asset subclass diversification. Within each asset class, further diversify by investing in different subclasses. For example, within stocks, you can diversify across industries, market sectors, and regions. 8. Alternative investments. Consider adding alternative investments, such as real estate investment trusts or REITs, commodities, and hedge funds to your portfolio. These assets often have low correlation with traditional stocks and bonds, providing additional diversification benefits. 9. Risk management strategies. Utilize risk management techniques such as stop-loss orders, options hedging, and diversification through low-cost index funds or exchange-traded funds or ETFs to reduce portfolio volatility. 10. Regular rebalancing. Periodically review and rebalance your portfolio to maintain your desired asset allocation and diversification targets. Market fluctuations can cause your portfolio to drift from its intended allocation, so rebalancing helps ensure that your risk exposure stays in line with your investment objectives. By implementing these diversification strategies, you can build a resilient investment portfolio that is better positioned to weather market fluctuations and achieve long-term financial goals. Chapter 3. Evaluating dividend stocks. Let's talk about how to evaluate different dividend stocks in this chapter. Fundamental analysis. When evaluating dividend stocks, consider the following key factors. 1. Dividend yield. Compare the dividend yield of the stock to similar stocks in its sector and the broader market. A higher yield may indicate an attractive income opportunity, but be cautious of excessively high yields as they could signal an unsustainable dividend or a declining stock price. 2. Dividend growth rate. Look for stocks with a history of consistent dividend growth. Companies that regularly increase their dividends demonstrate financial strength and management confidence in future earnings. 3. Payout ratio. Evaluate the company's payout ratio, which measures the percentage of earnings paid out as dividends. A lower payout ratio suggests that the company retains more earnings for growth or to weather economic downturns. Generally, a payout ratio below 60% is considered healthy. 4. Dividend sustainability. Assess the company's ability to sustain its dividend payments over the long term. Analyze factors such as cash flow, earnings stability, and debt levels to ensure the company can continue to afford its dividend obligations. 5. Financial health. Review the company's financial statements, including balance sheets, income statements, and cash flow statements, to assess its overall financial health. Look for signs of profitability, strong cash flow generation, and manageable debt levels. 6. Business model. Understand the company's business model and competitive advantages within its industry. Companies with durable competitive advantages, such as strong brands, intellectual property, or dominant market positions, are better positioned to maintain and grow dividends over time. 7. Industry outlook. Consider the industry dynamics and outlook for the company's sector. Some industries, such as utilities and consumer staples, are known for their stable dividend payments, while others may be more cyclical or prone to disruption. 8. Management quality. Evaluate the quality and track record of the company's management team. Look for management teams with a history of prudent capital allocation, shareholder-friendly policies, and a focus on long-term value creation. 9. Dividend policy. Understand the company's dividend policy and history of dividend payments. Some companies may prioritize dividends as a key component of shareholder returns, while others may prioritize reinvesting earnings for growth opportunities. 10. Market conditions. Consider current market conditions and macroeconomic factors that may impact the company's ability to pay dividends. Economic downturns, interest rate changes, and regulatory changes can all affect dividend stocks' performance. By carefully evaluating these factors, you can make informed decisions when selecting dividend stocks for your investment portfolio. Financial metrics to consider. When assessing dividend stocks, it's essential to consider various financial metrics to gauge their health and potential for long-term performance. Among these metrics are dividend yield. This metric calculates the annual dividend payment relative to the stock price, providing insight into the current return on investment from dividends. Dividend growth rate, an indicator of how rapidly a company's dividends have increased over time, reflecting financial strength and management confidence. Payout ratio. This ratio shows the percentage of earnings paid out as dividends, with a lower ratio suggesting more room for future dividend increases or business reinvestment. Dividend coverage ratio reflects the company's ability to cover its dividend payments from its earnings, with a ratio above 1 indicating sufficient coverage. Free cash flow. The cash generated by a company's operations after accounting for capital expenditures, crucial for sustaining dividend payments and supporting growth. Earnings per share, or EPS. The portion of a company's profit allocated to each outstanding share of common stock, influencing dividend growth potential. Revenue growth indicates the rate at which a company's revenue is increasing, reflecting market demand for its products or services. Debt-to-equity ratio, a measure of a company's financial leverage, with a high ratio potentially impacting its ability to maintain dividend payments. Return on equity, or ROE, reflects a company's profitability relative to its shareholders' equity, influencing its capacity to sustain dividends. Price-to-earnings ratio, or PE ratio, compares a company's stock price to its earnings per share, offering insight into its valuation compared to industry peers. By analyzing these metrics, investors can gain a comprehensive understanding of a company's financial health, dividend sustainability, and growth prospects, aiding in informed investment decisions. Qualitative factors. In addition to financial metrics, qualitative factors play a crucial role in evaluating dividend stocks. These qualitative factors provide insights into a company's overall business environment, management quality, and competitive advantages. Here are some key qualitative factors to consider. 1. Business model. Understand the company's business model and how it generates revenue. Assess whether the company operates in a stable industry with predictable cash flows or if it faces disruptive threats. 2. Competitive advantage. Identify the company's competitive advantages, such as strong brands, patents, proprietary technology, or economies of scale. Companies with durable competitive advantages are better positioned to maintain market share and profitability over the long term. 3. Industry dynamics. Evaluate the industry dynamics and the company's position within its industry. Consider factors such as industry growth prospects, regulatory environment, and competitive landscape. 4. Management quality. Assess the quality and track record of the company's management team. Look for management teams with a history of prudent capital allocation, strategic vision, and shareholder-friendly policies. 5. Corporate governance. Review the company's corporate governance practices, including board independence, executive compensation, and shareholder rights. Strong corporate governance helps ensure that management acts in the best interests of its shareholders. 6. Innovation and adaptability. Evaluate the company's ability to innovate and adapt to changing market conditions. Companies that continually invest in research and development and embrace technological advancements are better positioned for long-term success. 7. Customer base. Understand the company's customer base and the strength of its relationships with customers. Companies with loyal and diversified customer bases are more resilient to economic downturns and competitive threats. 8. Brand reputation. Consider the strength of the company's brand and reputation. A positive brand image can enhance customer loyalty, pricing power, and overall business resilience. 9. Regulatory environment. Assess the regulatory risks facing the company and its industry. Regulatory changes can impact profitability, market access, and compliance costs, so it's essential to understand and monitor regulatory developments. 10. Social and environmental responsibility. Evaluate the company's commitment to social and environmental responsibility. Companies that prioritize sustainability and corporate social responsibility may be better positioned to attract customers, employees, and investors over the long term. By considering these qualitative factors alongside financial metrics, investors can gain a holistic view of a company's investment potential and make more informed decisions when selecting dividend stocks. Chapter 4. Dividend Reinvestment Plans, or DRIPs. DRIPs, or Dividend Reinvestment Plans, are investment programs offered by companies that allow shareholders to automatically reinvest their dividends into additional shares of the company's stock. What is a DRIP? A DRIP, or Dividend Reinvestment Plan, is an investment program offered by companies that allows shareholders to automatically reinvest their dividends into additional shares of the company's stock. With DRIPs, Instead of receiving cash dividends, shareholders can acquire additional shares directly from the company, often at a discounted price or with no transaction fees. This allows investors to compound their returns over time by reinvesting dividends and acquiring more shares, potentially accelerating the growth of their investment portfolio. DRIPs are a popular option for long-term investors looking to build wealth gradually through dividend income and capital appreciation. Pros and cons of DRIPs. DRIPs, or dividend reinvestment plans, offer several benefits and drawbacks for investors. Pros. 1. Automatic compounding. DRIPs allow investors to automatically reinvest their dividends into additional shares of the company's stock. This compounding effect can accelerate the growth of an investment portfolio over time. 2. Cost efficiency. Many DRIPs offer the option to reinvest the dividends without incurring additional transaction fees or commissions. This can result in cost savings for investors, especially those with smaller investment amounts. 3. Fractional shares. DRIPs often allow investors to purchase fractional shares, enabling them to fully reinvest their dividends, even if the dividend amount doesn't cover the cost of a whole share. This maximizes the reinvestment of dividends and ensures efficient use of capital. 4. Long-term focus. DRIPs are well suited for long-term investors who prioritize accumulating wealth gradually through dividend income and capital appreciation. By reinvesting dividends, investors can benefit from the power of compounding over time. Cons. 1. Lack of flexibility. DRIPs typically operate on a set schedule, reinvesting dividends at predefined intervals. This lack of flexibility means investors have less control over when and how dividends are reinvested, which may not align with their investment strategy or timing preferences. 2. Tax implications. Although dividends reinvested through DRIPs are typically tax deferred until the shares are sold, investors should be aware of the potential tax consequences when eventually selling the shares. Capital gains taxes may apply to the sale of reinvested shares, depending on the holding period and tax laws. 3. Administrative hassles. Enrolling in a DRIP and managing multiple DRIP accounts can involve administrative tasks such as paperwork, account setup, and tracking dividend reinvestments. This additional administrative burden may deter some investors. 4. Limited investment options. DRIPs are only available for stocks that offer the program, which may limit investors' options for diversification. Additionally, DRIPs are typically offered by individual companies, so investors must open separate DRIP accounts for each stock in which they wish to participate. Overall, DRIPs can be a valuable tool for long-term investors seeking to reinvest dividends and grow their investment portfolios over time. However, investors should carefully consider the pros and cons of DRIPs in relation to their investment goals, risk tolerance, and individual circumstances. How to enroll in a DRIP. To enroll in a DRIP, start by confirming if the company's stock offers such a plan. Review the DRIP's details, including fees and reinvestment options. If you're not already a shareholder, purchase at least one share of the company's stock. Obtain and fill out the enrollment form, providing necessary information like account details and reinvestment preferences. Submit the form to the company's transfer agent as instructed. Upon processing, you'll receive confirmation of enrollment and account access details. Regularly monitor your DRIP account for dividend reinvestments and manage any changes to your preferences. Chapter 5. Strategies for maximizing dividend income. To maximize dividend income, investors can employ several strategies. Start by focusing on high-yield stocks with consistent dividend payouts and attractive yields compared to industry peers. Diversify your portfolio across sectors to mitigate risk and avoid dependence on any single company or sector. Consider enrolling in a dividend reinvestment plan or DRIP to compound returns by reinvesting dividends automatically. Look for dividend aristocrats, companies that have increased dividends for at least 25 consecutive years, for reliable income and potential capital appreciation. Target dividend growth stocks for higher initial yields and potential future increases. Include preferred stocks and real estate investment trusts, or REITs, for higher yields. Monitor payout ratios to ensure dividend sustainability. Focus on total return, considering both dividends and capital appreciation. Regularly review and rebalance your portfolio to maintain alignment with your investment goals. Finally, optimize tax efficiency by utilizing tax-advantaged accounts. Dividend growth investing. Dividend growth investing focuses on investing in companies with a track record of consistently increasing their dividend payments over time. The strategy prioritizes companies that not only pay dividends, but also have a history of raising them annually. Here's how dividend growth investing works. 1. Focus on quality companies. Look for companies with strong fundamentals, including stable earnings, healthy cash flow, and manageable debt levels. These companies are more likely to sustain and grow their dividend payments over the long term. 2. Long-term perspective. Dividend growth investing is a long-term strategy. Investors aim to build a portfolio of quality dividend-paying stocks and hold them for an extended period to benefit from the compounding effect of dividend reinvestment and increasing payouts. 3. Dividend aristocrats and achievers. Dividend aristocrats are companies that have increased their dividends for at least 25 consecutive years, while dividend achievers have a track record of increasing dividends for a shorter period, typically 10 or more years. These lists can serve as a starting point for identifying companies with a commitment to dividend growth. 4. Dividend yield versus dividend growth. While dividend yield is important, dividend growth investors prioritize companies with a history of consistent dividend increases over those with high initial yields but stagnant or declining payouts. Dividend growth stocks may initially offer lower yields but have the potential for higher income over time. 5. Reinvest dividends. Dividend growth investors often reinvest dividends to purchase additional shares of dividend-paying stocks. Reinvesting dividends accelerates the compounding effect, leading to exponential growth in dividend income over time. 6. Monitor company performance. Continuously monitor the financial health and performance of companies in your dividend growth portfolio. Assess factors such as earnings growth, payout ratios, and management quality to ensure that companies can continue increasing dividends in the future. 7. Diversification. Diversify your dividend growth portfolio across different sectors and industries to reduce risk. Avoid overconcentration in a single sector and strive for a balanced portfolio of high-quality dividend-paying stocks. 8. Patience and discipline. Dividend growth investing requires patience and discipline. It may take years for the compounding effect to significantly impact dividend income, but staying committed to the strategy can lead to substantial wealth accumulation over time. By following these principles, dividend growth investors aim to build a portfolio of high-quality companies that provide a growing stream of dividend income and long-term capital appreciation. High dividend yield investing. High dividend yield investing involves focusing on stocks that offer above-average dividend yields compared to the broader market. Investors seek out companies that pay generous dividends relative to their stock price, aiming to generate substantial income from dividend payments. This strategy prioritizes current income over capital appreciation, making it appealing to investors seeking regular cash flow from their investments. However, high dividend yield investing comes with risks, as excessively high yields may signal financial distress or an unsustainable dividend policy. Therefore, investors must conduct thorough research to ensure that high dividend-paying stocks are financially stable and capable of maintaining their dividend payments over the long term. Additionally, diversification is essential to mitigate risk, as concentrating too heavily on high dividend yield stocks within a single sector or industry can expose investors to sector-specific risks. Overall, high dividend yield investing can be a viable strategy for income-oriented investors, but it requires careful selection and monitoring of dividend-paying stocks to achieve sustainable returns. Hybrid approaches. Hybrid approaches in investing involve combining multiple strategies or techniques to achieve specific investment objectives. These approaches blend elements of different investment styles such as growth, value, income, or momentum to create a diversified portfolio that balances risk and return. For example, a hybrid approach might combine dividend growth investing with value investing to seek out undervalued stocks with strong dividend growth potential. Another example could involve blending passive index investing with active stock selection based on quantitative models. Hybrid approaches allow investors to leverage the strengths of different strategies while mitigating their weaknesses. By diversifying across multiple investment styles, asset classes, or management approaches, hybrid approaches aim to achieve more consistent returns across various market conditions. However, implementing hybrid approaches requires careful consideration of portfolio construction, risk management, and ongoing monitoring to ensure alignment with investment goals and objectives. Overall, hybrid approaches can provide investors with flexibility and adaptability in navigating dynamic market environments while pursuing their desired investment outcomes. Chapter 6. Tax considerations for dividend investors. Tax considerations are essential for dividend investors as they can impact the after-tax returns on dividend-paying investments. Taxation of dividends. The taxation of dividends depends on whether they are classified as qualified or non-qualified dividends. 1. Qualified dividends. Qualified dividends are subject to preferential tax rates, which are typically lower than ordinary income tax rates. To qualify for these lower tax rates, dividends must meet certain criteria, including being paid by U.S. corporations or qualified foreign corporations, and being held for a specified period, usually 60 days during the 121-day period surrounding the ex-dividend date. For most taxpayers, qualified dividends are taxed at the same rates as long-term capital gains, which are typically lower than ordinary income tax rates. 2. Non-qualified dividends. Non-qualified dividends do not meet the criteria for preferential tax treatment and are taxed at the taxpayer's ordinary income tax rates. Non-qualified dividends include dividends paid by real estate investment trusts, or REITs, master limited partnerships, or MLPs, and dividends from foreign corporations that do not meet the requirements for qualified dividend treatment. 3. Tax rates. The tax rates on qualified dividends depend on the taxpayer's income tax bracket. As of 2021, the tax rates on qualified dividends range from 0% for taxpayers in the 10% and 12% income tax brackets to 20% for taxpayers in the highest income tax bracket. Additionally, taxpayers with income above certain thresholds may be subject to an additional 3.8% net investment income tax, or NIIT, on their investment income, including dividends. 4. Reporting. Dividend income is reported on Form 1099 DIV, which is provided by brokerage firms and other financial institutions to investors. The form details the amount of dividends received during the tax year, including both qualified and non-qualified dividends, as well as any foreign tax withheld. Taxpayers must report dividend income on their federal income tax return, typically on Schedule B, Form 1040. 5. Qualified dividend holding period. To qualify for preferential tax treatment, shareholders must meet certain holding period requirements. For common stock, shareholders must hold the stock for more than 60 days during the 121-day period, beginning 60 days before the ex-dividend date. For preferred stock with a dividend rate lower than the applicable qualified dividend rate, shareholders must hold the stock for more than 90 days during the 181-day period, beginning 90 days before the ex-dividend date. 6. State taxes. In addition to federal taxes, dividends may also be subject to state income taxes, which vary by state. Some states tax dividends at ordinary income tax rates, while others offer preferential tax treatment similar to qualified dividends. Understanding the tax implications of dividends is essential for dividend investors to effectively manage their tax liability and maximize after-tax returns. Consulting with a tax professional can provide personalized guidance based on individual circumstances and tax laws. Qualified versus non-qualified dividends. Qualified dividends and non-qualified dividends are distinguished based on specific criteria that determine their tax treatment. 1. Qualified dividends. To be classified as qualified, dividends must meet certain requirements set by the Internal Revenue Service, or IRS. These requirements include: the dividends must be paid by a U.S. corporation or a qualified foreign corporation. The shareholder must hold the stock for a minimum period, typically 60 days during the 121-day period surrounding the ex-dividend date. The dividends cannot be listed as ineligible dividends, such as dividends from employee stock options, certain dividends on preferred stock, or dividends on deposits with mutual savings banks, cooperative banks, credit unions, and similar institutions. Qualified dividends are taxed at preferential long-term capital gains tax rates, which are typically lower than ordinary income tax rates. The tax rates on qualified dividends range from 0% to 20%, depending on the taxpayer's income tax bracket. 2. Non-qualified dividends. Dividends that do not meet the requirements for qualified status are classified as non-qualified dividends. These dividends may include dividends paid by real estate investment trusts or REITs, master limited partnerships or MLPs, and certain foreign corporations that do not meet the criteria for qualified dividend treatment. Dividends received on shares held for less than the required holding period. Dividends that are listed as ineligible dividends according to IRS guidelines. Non-qualified dividends are taxed at the shareholder's ordinary income tax rates, which are typically higher than the tax rates on qualified dividends. The tax rate on non-qualified dividends is based on the taxpayer's marginal tax bracket. Understanding the distinction between qualified and non-qualified dividends is important for tax planning purposes, as it can impact the amount of taxes owed on dividend income. Investors should review their dividend income and consult with a tax professional to determine the appropriate tax treatment for their specific situation. Tax-efficient investing strategies. Tax-efficient investing strategies aim to minimize the tax impact on investment returns. Here are some strategies investors can use to optimize tax efficiency. 1. Utilize tax-advantaged accounts. Maximize contributions to tax-advantaged accounts such as individual retirement accounts or IRAs, 401ks, and health savings accounts or HSAs. These accounts offer tax benefits such as tax-deferred or tax-free growth, allowing investments to compound without immediate tax consequences. 2. Asset location. Place tax-efficient investments such as tax-exempt bonds or index funds with low turnover in taxable brokerage accounts. Reserve tax-inefficient investments such as actively managed funds or high-dividend stocks for tax-advantaged accounts to minimize taxable income. 3. Tax loss harvesting. Offset to capital gains with capital losses by selling investments that have declined in value. Harvested losses can be used to offset capital gains and up to $3,000 of ordinary income per year, reducing taxable income and potentially lowering tax liability. 4. Dividend reinvestment plans, or DRIPs. Enroll in DRIPs to reinvest dividends automatically without incurring transaction fees. Reinvested dividends purchase additional shares at the current market price, allowing investors to compound returns tax efficiently over time. 5. Hold investments for the long term. Long-term investments held for more than 1 year are taxed at preferential long-term capital gains rates, which are typically lower than ordinary income tax rates. Avoid short-term trading, which can result in higher tax liabilities due to short-term capital gains being taxed at ordinary income tax rates. 6. Tax-efficient fund selection. Choose tax-efficient mutual funds or exchange-traded funds or ETFs with low turnover ratios and minimal capital gains distributions. Funds with low turnover generate fewer taxable events, reducing the tax burden on investors. 7. Consider municipal bonds. Invest in municipal bonds, which are typically exempt from federal income tax and may also be exempt from state and local taxes if issued within the investor's state of residence. Municipal bonds can provide tax-free income for investors in higher tax brackets. 8. Tax-efficient withdrawal strategies. Develop tax-efficient withdrawal strategies in retirement by carefully managing withdrawals from taxable, tax-deferred, and tax-free accounts. Consider factors such as required minimum distributions, or RMDs, tax brackets, and anticipated future income needs to minimize tax implications. 9. Stay informed. Stay informed about changes in tax laws and regulations that may impact investment strategies. Regularly review investment portfolios and tax planning strategies to adapt to changing tax environments and optimize tax efficiency. By implementing these tax-efficient investing strategies, investors can reduce tax liabilities and maximize after-tax returns on their investments. It's important to consult with a qualified tax professional or financial advisor to develop personalized tax-efficient investment plans based on individual circumstances and goals. Chapter 7. Monitoring and managing your dividend portfolio. Monitoring and managing your dividend portfolio is essential for maximizing returns and ensuring the portfolio remains aligned with your investment goals. Tracking performance. Tracking the performance of your dividend portfolio is crucial for evaluating its success and making informed investment decisions. Here's how to effectively track performance. 1. Establish benchmarks. Compare the performance of your dividend portfolio against relevant benchmarks, such as market indexes or dividend-focused indices like the S&P 500 Dividend Aristocrats. This provides a benchmark for assessing performance relative to the broader market or a specific investment strategy. 2. Monitor total return. Track the total return of your dividend portfolio, which includes both dividend income and capital appreciation. Total return provides a comprehensive measure of portfolio performance and reflects the combined impact of dividends and changes in stock prices. 3. Track dividend income. Monitor the dividend income generated by your portfolio over time. Keep records of dividend payments received from individual holdings and calculate the total dividend income for each period. Tracking dividend income allows you to assess the reliability and growth of dividend payments. 4. Review dividend yield. Keep an eye on the dividend yield of your portfolio, which is the annual dividend income divided by the portfolio's market value. Changes in dividend yield may signal shifts in the portfolio's composition, changes in dividend policies, or fluctuations in stock prices. 5. Assess dividend growth. Evaluate the growth rate of dividend income over time. Track changes in dividend payments from individual holdings and calculate the annualized growth rate of dividend income. Consistent dividend growth is a key indicator of a healthy dividend portfolio. 6. Monitor portfolio composition. Regularly review the composition of your dividend portfolio to ensure it remains diversified and aligned with your investment objectives. Assess sector allocations, individual stock holdings, and any changes in portfolio concentration. 7. Consider tax implications. Factor in the tax implications of dividend income when evaluating portfolio performance. Monitor tax-efficient strategies such as holding dividend-paying stocks in tax-advantaged accounts and harvesting tax losses to minimize tax liabilities. 8. Adjust portfolio allocation. Based on performance reviews and changes in market conditions, consider adjusting the allocation of your dividend portfolio. Rebalance the portfolio periodically to maintain diversification and manage risk effectively. By actively tracking the performance of your dividend portfolio and regularly reviewing key metrics, you can assess its progress, identify areas for improvement, and make informed decisions to optimize returns over time. Rebalancing your portfolio. Rebalancing your portfolio is crucial for managing risk and ensuring your investments stay aligned with your goals. Here's how to do it effectively. First, establish your target asset allocation based on your investment objectives and risk tolerance. Regularly monitor your portfolio's performance and asset allocation. Identify thresholds for each asset class to trigger rebalancing, typically around a 5% deviation from your target allocation. Review individual holdings within each asset class, considering factors like valuation and growth prospects. When deviations exceed your thresholds, reallocate assets to bring your portfolio back into balance. Consider tax implications when rebalancing taxable accounts, utilizing tax-efficient strategies like tax loss harvesting. Rebalance your portfolio on a regular schedule or when significant deviations occur, such as annually or semi-annually. Continuously monitor your portfolio's performance and adjust your target allocation as needed to reflect changes in your goals or market conditions. By rebalancing systematically and staying disciplined, you can effectively manage risk and keep your investments on track to meet your long-term objectives. Responding to changes in the market. In managing your investment portfolio amid market changes, staying informed and disciplined is crucial. Regularly review your investment thesis, rebalance your portfolio to align with your target allocation, and capitalize on opportunities presented by market fluctuations. Mitigate risks by diversifying your holdings and seeking professional guidance when needed. By remaining flexible and adapting to changing market dynamics, you can position yourself for long-term success in the financial markets. Chapter 8. Overcoming Common Challenges. Overcoming common challenges in investing requires awareness, resilience, and strategic approaches. Some common challenges investors face include market volatility, emotional biases, and uncertainty. Dealing with market volatility. Dealing with market volatility can be challenging, but there are effective strategies to navigate turbulent times. First, maintain a calm and rational approach, avoiding impulsive decisions driven by short-term fluctuations. Diversify your portfolio across different asset classes, sectors, and geographic regions to reduce risk. Regularly review and rebalance your portfolio to realign with your target allocation, selling overperforming assets and buying underperforming ones. Focus on the fundamentals of your investments, such as earnings, growth, and competitive positioning. Keep cash reserves on hand to cover expenses and seize opportunities during market downturns. Consider dollar cost averaging to invest consistently over time, regardless of market conditions. Lastly, seek professional guidance from a qualified advisor to develop a personalized strategy for managing market volatility and staying on track with your long-term goals. Avoiding common pitfalls. Avoiding common pitfalls in investing requires discipline, awareness, and sound decision-making. Here are some key pitfalls to watch out for and how to avoid them. 1. Emotional investing. Avoid making investment decisions based on emotions such as fear or greed. Stay disciplined and rational, sticking to your investment plan even during periods of market volatility. 2. Overtrading. Resist the urge to trade frequently in response to short-term market movements. Overtrading can lead to increased transaction costs, tax implications, and diminished returns over time. Focus on long-term investment goals and avoid unnecessary trading. 3. Chasing performance. Avoid chasing hot stocks or investment trends based solely on recent performance. Past performance is not indicative of future results, and chasing performance can lead to buying high and selling low. Conduct thorough research and focus on the fundamentals of investments rather than short-term price movements. 4. Lack of diversification. Avoid concentrating your investments in a single asset class, sector, or individual stock. Diversification helps spread risk and reduce the impact of any single investment on your portfolio. Maintain a diversified portfolio across different asset classes, industries, and geographic regions. 5. Ignoring fees and expenses. Be mindful of the fees and expenses associated with investing, including management fees, transaction costs, and taxes. High fees can erode investment returns over time, so seek low-cost investment options such as index funds and ETFs whenever possible. 6. Not having an investment plan. Avoid investing without a clear investment plan or strategy. Define your investment goals, risk tolerance, and time horizon, and develop a well-diversified portfolio aligned with your objectives. Regularly review and adjust your plan as needed based on changes in your circumstances or market conditions. 7. Lack of patience. Investing requires patience and a long-term perspective. Avoid reacting impulsively to short-term market fluctuations and focus on the long-term growth potential of your investments. Stay committed to your investment plan and avoid making knee-jerk reactions to market noise. By avoiding these common pitfalls and maintaining a disciplined approach for investing, you can increase your chances of achieving long-term investment success and reaching your financial goals. Staying disciplined in your strategy. Maintaining discipline in your investment strategy is vital for long-term success. Start by setting clear goals that outline your objectives, time horizon, and risk tolerance. Develop a well-defined investment plan that includes your asset allocation, diversification strategy, and risk management approach. Stay informed about market trends and economic indicators to make informed decisions. Automate your investing to stay consistent, regardless of market conditions. Avoid market timing and focus on long-term investing instead. Regularly monitor your portfolio's progress, rebalancing as needed, and seek professional guidance if necessary. Finally, practice patience and trust in your strategy, even during periods of uncertainty. By staying disciplined, you can navigate market fluctuations and work toward your financial goals effectively. You have been listening to Dividend Investing, Passive Income and Growth Investing for Beginners. Written by Daniel Shore. Narrated by Jacob Simmons. Conclusion. In conclusion, successfully managing your investment portfolio requires discipline, focus, and a long-term perspective. By setting clear goals, developing a well-defined investment plan, and staying informed about market trends, you can make informed decisions and stay on track to achieve your objectives. Automating your investing, avoiding market timing, and seeking professional guidance when needed are essential components of maintaining discipline in your strategy. Remember to monitor your portfolio's progress regularly, rebalance as needed, and practice patience during periods of market volatility. With discipline and perseverance, you can navigate market fluctuations and work towards building a financially secure future. Estate planning. Plan your estate and your will. Written by Daniel Shore. Narrated by Jacob Simmons. 1. Introduction to estate planning. Estate planning is the process of arranging for the management and disposal of a person's estate during their life and after death. It involves creating legal documents such as wills, trusts, and powers of attorney to ensure that your assets are distributed according to your wishes, minimize taxes, and provide for your loved ones. It's important to regularly review and update your estate plan to reflect changes in your life circumstances and the law. 2. Understanding your estate. Understanding your estate involves a comprehensive assessment of all your assets and liabilities, encompassing various aspects of your financial life. Your estate includes tangible assets such as real estate, vehicles, jewelry, and personal belongings, as well as intangible assets like bank accounts, investments, retirement savings, and intellectual property. Additionally, your estate encompasses any debts or liabilities you may have, including mortgages, loans, credit card balances, and outstanding bills. It's crucial to have a clear understanding of both your assets and liabilities to effectively plan for the distribution and management of your estate. Once you have a complete overview of your estate's value, you can begin to strategize how you want your assets to be handled after your passing. This often involves creating legal documents such as wills, trusts, and powers of attorney to designate beneficiaries, specify how assets should be distributed, and appoint individuals to manage your affairs in the event of incapacity. Considering the tax implications of your estate is also essential. Estate taxes and inheritance taxes can significantly impact the value of your estate and the amount ultimately received by your beneficiaries. Estate planning strategies can help minimize tax liabilities and maximize the wealth passed on to your loved ones. Regularly reviewing and updating your estate plan is crucial, especially when significant life events occur, such as marriage, divorce, birth of children or grandchildren, or changes in financial circumstances. By staying proactive and adaptable, you can ensure that your estate plan remains aligned with your wishes and provides maximum benefits to your heirs. 3. Setting your goals and objectives. Setting goals and objectives for your estate plan is a crucial step in ensuring that your wishes are carried out effectively. Start by clarifying your overarching objectives, such as providing financial security for your family, minimizing taxes, preserving assets for future generations, or supporting charitable causes. Next, break down these objectives into specific, actionable goals. For example, if your goal is to provide for your family's financial security, you might aim to establish a trust fund to support your children's education or designate beneficiaries for your retirement accounts and life insurance policies. Consider your values and priorities when setting these goals. You may prioritize passing on a family business or heirlooms, ensuring healthcare decisions are made according to your wishes, or supporting philanthropic endeavors. It's essential to be realistic and practical when setting goals, taking into account your current financial situation, family dynamics, and potential challenges or obstacles. Once you've established your goals and objectives, work with a qualified estate planning attorney or financial advisor to develop a comprehensive plan that aligns with your priorities and addresses your specific needs. Regularly review and update your plan as circumstances change to ensure that it continues to reflect your goals and objectives over time. 4. Essential estate planning documents. Several essential estate planning documents can help you manage and distribute your assets according to your wishes. 1. Last will and testament. A will outlines how you want your assets distributed after your death. It can also designate guardians for minor children and specify funeral arrangements. 2. Revocable living trust. A trust allows you to transfer ownership of your assets to a trustee to manage on behalf of beneficiaries. Unlike a will, a trust can help avoid probate and provide privacy in asset distribution. 3. Durable power of attorney. This document appoints someone to make financial decisions on your behalf if you become incapacitated. It's essential for managing your affairs if you're unable to do so yourself. 4. Healthcare proxy, or medical power of attorney. This appoints someone to make medical decisions for you if you're unable to do so. It ensures your healthcare wishes are followed even if you can't communicate them. 5. Living will, or advance directive. A living will outlines your preferences for end-of-life medical care, such as whether you want life-sustaining treatments if you're terminally ill or in a vegetative state. 6. Beneficiary designations. These specify who will receive the assets of certain accounts or insurance policies upon your death. Keeping these designations up to date ensures your assets go to the intended beneficiaries. 7. Letter of intent. While not legally binding document, a letter of intent provides guidance to your executor or beneficiaries on how you want specific aspects of your estate handled. Consult with an estate planning attorney to determine which documents are appropriate for your situation and to ensure they comply with state laws. Regularly review and update these documents as needed to reflect changes in your life circumstances. Last will and testament. A last will and testament, commonly referred to as a will, is a legal document that outlines your wishes regarding the distribution of your assets and the care of any minor children upon your death. Here's what it typically includes. 1. Asset distribution. Your will specifies how you want your property and assets to be distributed among your beneficiaries. This can include real estate, investments, personal belongings, and any other assets you own. 2. Executor. You appoint an executor, also known as a personal representative, to oversee the distribution of your assets according to your wishes. The executor is responsible for carrying out the instructions in your will, managing your estate affairs, paying debts and taxes, and distributing assets to beneficiaries. 3. Guardianship. If you have minor children, your will can designate guardians to care for them in the event of your death. This ensures that your children are cared for by someone you trust and who shares your values. 4. Funeral and burial wishes. Your will may include instructions for your funeral arrangements and preferences for burial or cremation. It's important to keep your will updated to reflect any changes in your circumstances, such as marriage, divorce, the birth of children or grandchildren, or changes in your assets. Additionally, ensure that your will complies with the legal requirements of your state to ensure its validity. While a will is an essential estate planning document, it's important to note that it typically goes through probate, a court-supervised process of administering and distributing your assets. Depending on your situation, you may also want to consider other estate planning tools, such as trusts, to avoid or minimize probate and provide additional benefits to your heirs. Consulting with an estate planning attorney can help you create a comprehensive plan that meets your goals and needs. Revocable Living Trust. A revocable living trust is a legal document that allows you to transfer ownership of your assets into the trust during your lifetime, with the flexibility to amend or revoke it as needed. In creating the trust agreement, you outline how your assets will be managed and distributed both during your lifetime and after your death. You appoint yourself as the initial trustee, maintaining control over the assets. The process of transferring ownership of your assets into the trust is known as funding the trust. As the trustee, you continue to manage the assets in the trust for your benefit during your lifetime, with full control to buy, sell, or use the assets as you see fit. Additionally, you designate a successor trustee to manage the trust and distribute assets according to your instructions upon your incapacity or death, ensuring continuity in trust administration without the need for court intervention. You also designate beneficiaries who will receive the assets held in the trust upon your death, which can include family members, friends, charities, or other entities. Benefits of a revocable living trust include avoiding probate, incapacity planning, flexibility, and privacy. However, it's essential to consult with an experienced estate planning attorney to determine if it's the right tool for your needs and ensure it aligns with your overall estate planning goals. Advance Directive or Living Will. An advance directive, commonly known as a living will, is a legal document that outlines your preferences for medical care and treatment in the event that you are unable to communicate your wishes due to incapacity. Here's how it works. 1. Medical preferences. In your advance directive, you specify your preferences regarding medical treatments, procedures, and interventions. This can include decisions about life-sustaining treatments, resuscitation, and the use of artificial nutrition and hydration. 2. End-of-life care. You can express your preferences for end-of-life care, such as whether you want to be kept comfortable and pain-free, receive palliative care, or have life-sustaining treatments withheld or withdrawn if you are in a terminal condition or persistent vegetative state. 3. Healthcare proxy. In addition to outlining your medical preferences, you can appoint a healthcare proxy, also known as a medical power of attorney, to make healthcare decisions on your behalf if you are unable to do so yourself. Your healthcare proxy should be someone you trust to advocate for your wishes and make decisions in your best interests. 4. Legal requirements. Advance directives must comply with the legal requirements of your state to be valid. This may include signing the document in the presence of witnesses or having it notarized. 5. Communication with healthcare providers. It's essential to communicate your advance directive to your healthcare providers, family members, and anyone else involved in your medical care to ensure that your wishes are known and respected. An advance directive gives you peace of mind knowing that your medical preferences will be honored even if you are unable to communicate them yourself. It empowers you to maintain control over your healthcare decisions and relieve your loved ones of the burden of making difficult choices on your behalf. Regularly reviewing and updating your advance directive as needed ensures that it reflects your current wishes and circumstances. Consulting with an attorney or healthcare professional can help you create a comprehensive advance directive that meets your needs and complies with applicable laws. Durable power of attorney. A durable power of attorney is a legal document that grants someone else, known as your agent or attorney in fact, the authority to make financial and legal decisions on your behalf if you become incapacitated or unable to manage your affairs. Here's how it works. 1. Authority. When you create a durable power of attorney, you authorize your chosen agent to act on your behalf in financial and legal matters. This authority can include managing bank accounts, paying bills, signing contracts, filing taxes, and making investment decisions. 2. Durability. Unlike a regular power of attorney, which may become invalid if you become incapacitated, a durable power of attorney remains in effect even if you are unable to make decisions for yourself. This ensures continuity in managing your affairs if you become incapacitated due to illness, injury, or aging. 3. Scope of authority. You have the flexibility to specify the extent of your agent's authority in the durable power of attorney document. You can grant broad authority to handle all financial and legal matters or limit it to specific tasks or transactions. 4. Choosing an agent. It's crucial to choose a trustworthy and reliable individual to serve as your agent. This person should be someone who understands your wishes, shares your values, and is capable of making sound financial and legal decisions on your behalf. 5. Legal requirements. Durable power of attorney documents must comply with the legal requirements of your state to be valid. This may include signing the document in the presence of witnesses or having it notarized. 6. Revocability. You have the right to revoke or amend the durable power of attorney at any time while you are mentally competent. This gives you the flexibility to change agents or modify the scope of authority as needed. Creating a durable power of attorney is an essential part of estate planning, as it ensures that someone you trust will be able to manage your affairs and make decisions on your behalf if you are unable to do so yourself. It's important to discuss your wishes with your chosen agent and ensure they understand their responsibilities and obligations. Consulting with an attorney experienced in estate planning can help you create a comprehensive, durable power of attorney that meets your needs and complies with applicable laws. 5. Choosing executors and trustees. Choosing executors and trustees for your estate plan is a significant decision that requires careful consideration. Here's what you need to know. 1. Executor. An executor is responsible for managing the administration of your estate after your death. Their duties include gathering assets, paying debts and taxes, distributing assets to beneficiaries according to your will, and handling any legal proceedings such as probate. When choosing an executor, consider someone who is trustworthy, organized, and capable of handling financial matters. This could be a family member, friend, attorney, or financial institution. 2. Trustee. A trustee is responsible for managing assets held in a trust for the benefit of beneficiaries. Their duties include investing trust assets, distributing income and principal according to the trust's terms, and ensuring compliance with legal and fiduciary obligations. When selecting a trustee, it's important to choose someone with financial acumen, integrity, and the ability to act impartially in the best interests of the beneficiaries. This could be a family member, friend, attorney, financial advisor, or corporate trustee. Consider the following factors when choosing executors and trustees. Trustworthiness. Look for individuals who are trustworthy, responsible, and have integrity. They should be capable of handling sensitive financial and legal matters with honesty and transparency. Capability. Consider the individual's ability to manage complex financial affairs, navigate legal processes, and make sound decisions in accordance with your wishes and the law. Availability. Ensure that the chosen executors and trustees are willing and available to fulfill their duties when needed. They should be able to dedicate the time and effort required to carry out their responsibilities effectively. Impartiality. Executors and trustees must act impartially and without conflicts of interest. Avoid choosing individuals who may have personal or financial conflicts with beneficiaries or who may be unable to act objectively. Succession planning. Consider appointing alternate or successor executors and trustees in case your primary choices are unable or unwilling to serve when the time comes. Professional assistance. In some cases, it may be advisable to enlist the services of professionals, such as attorneys, financial advisors, or corporate trustees, to act as executors or trustees, particularly for complex estates or trusts. Ultimately, choosing executors and trustees is a highly personal decision that should reflect your values, preferences, and the unique circumstances of your estate. Discuss your choices with your chosen individuals or professionals and ensure that they understand their roles and responsibilities within your estate plan. Regularly review and update your choices as needed to reflect changes in your circumstances or relationships. 6. Estate tax planning. Estate tax planning is the process of strategically arranging your financial affairs to minimize the impact of estate taxes on your estate and maximize the amount of wealth transferred to your beneficiaries. Here's how it works. 1. Understanding estate taxes. Estate taxes are taxes imposed on the transfer of your estate to your heirs upon your death. The federal government and some states levy estate taxes based on the total value of your estate above a certain exemption amount. It's crucial to understand the applicable estate tax laws and exemptions in your jurisdiction. 2. Asset valuation. Properly valuing your assets is essential for accurate estate tax planning. This includes real estate, investments, retirement accounts, business interests, and personal property. Professional appraisals may be necessary for certain assets to determine their fair market value. 3. Tax-exempt gifts. One strategy for reducing estate taxes is to make tax-exempt gifts during your lifetime. You can gift a certain amount of money or assets each year to individuals without incurring gift tax. Additionally, payments made directly for someone's medical expenses or educational tuition are exempt from gift tax. 4. Irrevocable trusts. Irrevocable trusts can be used to remove assets from your taxable estate, thereby reducing your potential estate tax liability. Assets placed in an irrevocable trust are no longer considered part of your estate for tax purposes, but you relinquish control over them. There are various types of irrevocable trusts, each with its own benefits and considerations. 5. Lifetime gifting strategies. Strategic gifting during your lifetime can help reduce the size of your taxable estate. By gradually transferring assets to your beneficiaries, you can take advantage of an annual gift tax exclusions and lifetime gift tax exemptions to minimize estate taxes. 6. Charitable giving. Charitable giving can provide tax benefits while supporting causes you care about. Donations to qualified charitable organizations are deductible from your taxable estate and can reduce estate taxes. Charitable trusts, donor-advised funds, and other charitable giving vehicles offer additional tax planning opportunities. 7. Life insurance. Life insurance can be a valuable tool for estate tax planning, providing liquidity to cover estate taxes or equalize inheritances among beneficiaries. Properly structured life insurance policies can help preserve your estate's value and provide for your loved ones' financial needs. Estate tax planning should be integrated into your overall financial and estate planning strategy to ensure that your assets are transferred efficiently and in accordance with your wishes. Consulting with an experienced estate planning attorney or financial advisor can help you navigate the complexities of estate tax laws and develop a comprehensive plan tailored to your specific circumstances and objectives. Regular reviews and updates to your estate plan are essential to address changes in tax laws, financial circumstances, and personal goals over time. 7. Asset protection strategies. Asset protection strategies are methods used to safeguard your wealth and assets from potential creditors, lawsuits, and other financial risks. Here are some common asset protection strategies. 1. Insurance. Adequate insurance coverage is the first line of defense against unforeseen risks. This includes homeowners insurance, auto insurance, liability insurance, umbrella policies, and professional liability insurance. Review your insurance policies regularly to ensure they provide sufficient coverage for your assets and potential liabilities. 2. Asset titling. The way you title your assets can affect their vulnerability to creditors. For example, holding assets jointly with your spouse may provide protection from individual creditors, while assets held solely in your name may be more vulnerable. Certain types of ownership, such as tenancy by the entirety or community property, offer additional protection in some states. 3. Retirement accounts. Assets held in qualified retirement accounts, such as 401ks, IRAs, and pension plans, are often protected from creditors under federal and state laws. Maximize contributions to these accounts to shield assets from potential claims. 4. Homestead exemptions. Many states offer homestead exemptions, which protect a certain amount of equity in your primary residence from creditors. Take advantage of these exemptions by ensuring that your home qualifies and applying for the exemption if necessary. 5. Asset protection trusts. Certain types of trusts, such as domestic asset protection trusts or DAPTs, and offshore trusts, can provide enhanced protection for your assets. These trusts are established with the primary purpose of shielding assets from potential creditors while allowing you to retain some level of control and benefit from the assets. 6. Family Limited Partnerships, or FLPs, and Limited Liability Companies, or LLCs. FLPs and LLCs can be used to consolidate and manage assets while providing liability protection. By transferring assets to these entities, you may shield them from personal creditors while retaining control and management authority. 7. Prenuptial and postnuptial agreements. These legal agreements can define the ownership and division of assets in the event of divorce or separation, providing protection for assets acquired before or during the marriage. 8. Offshore structures. Offshore accounts, corporations, and trusts can provide additional layers of asset protection, though they come with increased complexity and regulatory considerations. Consult with legal and financial professionals familiar with offshore planning to explore these options. It's essential to implement asset protection strategies proactively and within the bounds of the law. Attempting to shield assets after a liability arises may be considered fraudulent conveyance and could be subject to legal challenge. Consult with experienced legal and financial professionals to develop a comprehensive asset protection plan tailored to your specific needs and circumstances. 8. Planning for incapacity. Planning for incapacity involves preparing for the possibility of being unable to manage your affairs or make decisions about your healthcare and finances due to illness, injury, or cognitive decline. Key steps in incapacity planning include creating advance directives, such as a healthcare proxy and living will, to appoint someone to make medical decisions on your behalf and outline your preferences for end-of-life care. Additionally, establishing a durable power of attorney designates someone to handle your financial and legal matters if you become incapacitated. Consider setting up a revocable living trust to manage your assets during incapacity. Communicate your wishes with your chosen representatives and family members, and regularly review and update your plan as needed. Long-term care planning, organizing healthcare information, and seeking advice from legal and financial professionals are also important aspects of incapacity planning. 9. Providing for minor children and dependents. Providing for minor children and dependents is a crucial aspect of estate planning, ensuring their financial security and well-being in the event of your incapacity or death. Here's how to approach it. 1. Guardianship. Designate guardians for your minor children in your will. Choose individuals who share your values, parenting style, and willingness to raise your children. Discuss your choice with potential guardians to ensure they are willing and able to take on this responsibility. 2. Trusts. Consider establishing trusts to manage assets for the benefit of minor children and dependents. A trust allows you to specify how and when funds are distributed to ensure they are used for the intended purposes, such as education, healthcare, and living expenses. Designate a trustee to manage the trust on behalf of the beneficiaries. 3. Life insurance. Purchase life insurance to provide financial support for your children and dependents in the event of your death. The death benefit can help cover ongoing living expenses, education costs, and other financial needs. Consider naming a trust as the beneficiary of the life insurance policy to ensure funds are managed according to your wishes. 4. Beneficiary designations. Review and update beneficiary designations on retirement accounts, life insurance policies, and other assets to ensure they align with your estate plan. Consider establishing trusts or custodial accounts for minor beneficiaries to manage inherited assets until they reach adulthood or a specified age. 5. Letter of intent. Write a letter of intent to provide guidance to your guardians and trustees regarding your wishes for the care and upbringing of your children. Include information about their routines, preferences, medical history, and any special needs or considerations. 6. Educational planning. Set aside funds or establish accounts specifically for your children's education expenses, such as 529 college savings plans or education trusts. Consider factors such as tuition costs, inflation, and the expected duration of education when determining funding goals. 7. Legal and financial advice. Seek advice from legal and financial professionals experienced in estate planning and guardianship issues. They can help you create a comprehensive plan tailored to your family's needs and circumstances, ensuring that your minor children and dependents are provided for according to your wishes. Regularly review and update your estate plan as needed, especially when significant life events occur, such as the birth of additional children, changes in guardianship preferences, or fluctuations in financial circumstances. By taking proactive steps to provide for your minor children and dependents, you can ensure their continued care and well-being even in your absence. 10. Charitable giving. Charitable giving is a meaningful way to support causes you care about while making a positive impact on your community and the world. Here's how to approach charitable giving. 1. Identify causes. Start by identifying causes or organizations that align with your values and interests. Whether it's education, healthcare, environmental conservation, social justice, or humanitarian aid, there are countless charities and nonprofits addressing a wide range of issues. 2. Research charities. Research potential charities to ensure they are reputable, effective, and well-managed. Look for organizations with a clear mission, transparent financials, and a track record of impact. Websites such as Charity Navigator, GuideStar, and GiveWell provide valuable information and ratings for evaluating charities. 3. Set giving goals. Determine how much you can afford to give and set specific giving goals based on your financial circumstances and philanthropic priorities. Consider both one-time donations and recurring contributions, such as monthly or annual gifts. 4. Choose giving methods. There are various ways to give to charity, including cash donations, donations of appreciated assets, such as stocks or real estate, donor-advised funds, charitable trusts, and planned giving options like bequests in your will or charitable gift annuities. Choose the method that best suits your preferences and financial situation. 5. Maximize impact. Consider the impact you want to achieve with your charitable giving. Look for opportunities to leverage your donations through matching gift programs, challenge grants, or collaborative funding initiatives. Focus on supporting organizations and programs with measurable outcomes and sustainable solutions. 6. Engage personally. Get involved with the causes you support by volunteering your time, skills, or expertise. Many nonprofits welcome volunteers for various activities, such as fundraising events, community outreach, or hands-on service projects. Your personal involvement can deepen your connection to the cause and enhance the impact of your giving. 7. Plan for tax benefits. Take advantage of potential tax benefits associated with charitable giving. Depending on your country's tax laws, donations to qualified charities may be tax-deductible, reducing your taxable income and overall tax liability. Consult with a tax advisor to understand the tax implications of your charitable contributions. 8. Evaluate and adapt. Regularly evaluate the effectiveness of your charitable giving and adjust your philanthropic strategy as needed. Stay informed about emerging issues, evolving needs, and new opportunities for impact, and be open to exploring different approaches to giving over time. By thoughtfully considering your charitable giving goals, researching organizations, and maximizing the impact of your donations, you can make a meaningful difference in the lives of others and contribute to positive change in your community and beyond. 11. Business succession planning. Business succession planning is a process that involves preparing for the smooth transition of leadership and ownership of a business from one generation to the next, or from one owner to another. Starting early is key, as it allows for careful consideration of options and gradual implementation of changes. Begin by identifying your objectives, such as preserving the business legacy, ensuring continuity of operations, and minimizing tax liabilities. Assess the skills and capabilities of potential successors within the organization and provide them with the necessary training and development. Develop a comprehensive succession plan outlining the steps and timelines for transferring ownership and leadership. Clearly define roles and responsibilities. Communicate openly with stakeholders and address financial implications and legal structures. Regularly review and update the succession plan to reflect changes in the business environment and family dynamics. By proactively addressing business succession, you can ensure a smooth transition and long-term success for the business. 12. Estate planning for blended families. Estate planning for blended families demands careful consideration and sensitivity. Open communication is crucial, fostering honest discussions about goals, values, and expectations. Define family roles clearly to mitigate misunderstandings and conflicts. Identify beneficiaries thoughtfully, taking into account the need of all family members, including stepchildren. Consider establishing trusts to ensure fair and equitable distribution of assets among spouses and children from previous relationships. Regularly update beneficiary designations to reflect changing circumstances. Anticipate and address potential challenges, such as disagreements or legal complexities, with the guidance of an experienced estate planning attorney. Include contingency plans for unforeseen events, like the incapacity of a spouse or family member. Review and update your estate plan regularly to adapt to changes in family dynamics, relationships, and financial situations. By taking these steps, you can create an estate plan that protects your loved ones and ensures your wishes are carried out as intended. 13. Digital estate planning. Digital estate planning involves organizing and managing your online presence and digital assets to ensure they are handled appropriately in the event of your incapacity or death. Start by taking inventory of all your digital assets, including email accounts, social media profiles, online banking and investments accounts, digital photos and videos, and any other online accounts or property you own. Securely store login credentials for these accounts and consider designating a digital executor or trustee to manage them on your behalf. Clearly specify your wishes for your digital assets in your estate planning documents, taking into account privacy concerns and security measures. Regularly review and update your digital estate plan to reflect changes in your online presence and account information. Seek guidance from professionals, such as estate planning attorneys or digital estate planning specialists, to ensure your digital estate plan is comprehensive and legally sound. By taking these steps, you can ensure that your digital legacy is managed according to your wishes and provide clarity for your loved ones during a challenging time. 14. Reviewing and updating your estate plan. Regularly reviewing and updating your estate plan is crucial to ensure that it remains current and aligned with your wishes, as well as any changes in your life circumstances or legal requirements. Set a schedule to review your estate plan at least once a year or whenever significant life events occur, such as marriage, divorce, birth or adoption of children, death of a loved one, or changes in financial circumstances. Evaluate any changes in your life circumstances that may impact your estate plan, such as changes in relationships, health, finances, or residency. Consider how these changes may affect your beneficiaries, assets, or preferences for distribution. Review and update beneficiary designations on retirement accounts, life insurance policies, and other assets to ensure they reflect your current wishes and circumstances. Keep in mind that beneficiary designations supersede instructions in your will or trust. Evaluate your choice of personal representatives, trustees, guardians, and agents named in your estate planning documents. Ensure they are still willing and able to fulfill their roles effectively, and consider naming alternate representatives if necessary. Review how your assets are titled and consider whether changes are needed to align with your estate planning goals. For example, transferring ownership of assets to a trust can help avoid probate and provide additional privacy and control over distribution. Stay informed about changes in estate planning laws, tax regulations, and other legal requirements that may affect your estate plan. Consult with legal and financial professionals to ensure your plan remains compliant and optimized for tax efficiency. Revisit your estate planning goals and priorities and consider any new goals or objectives you may have. Update your plan accordingly to reflect changes in your values, priorities, or charitable intentions. Communicate openly with family members and loved ones about your estate plan and any updates you make. Ensure they understand your wishes and intentions, especially if changes may affect them directly. Store your estate planning documents in a secure location, such as a fireproof safe or safe deposit box, and ensure that trusted individuals know where to find them if needed. Consult with an experienced estate planning attorney or financial advisor to review your estate plan and address any questions or concerns you may have. They can provide valuable guidance and assistance in updating your plan to reflect your current circumstances and goals. By regularly reviewing and updating your estate plan, you can ensure that it remains relevant, effective, and aligned with your wishes, providing peace of mind for you and your loved ones. You have been listening to Estate Planning. Plan Your Estate and Your Will. Written by Daniel Shore. Narrated by Jacob Simmons. Trust funds, hometown investments, and mutual funds for beginners. Written by Daniel Shore. Narrated by Jacob Simmons. 1. Introduction to trust funds. Trust funds can be quite versatile and serve various purposes depending on the needs and goals of the grantor. They can be set up during one's lifetime, living trusts, or established through a will upon death, testamentary trusts. Trusts can be revocable, meaning the grantor retains control and can modify or revoke the trust during their lifetime. Or irrevocable, where the terms are fixed and cannot be changed. Common types of trust funds include 1. Revocable living trusts. These allow the grantor to retain control of assets during their lifetime and typically transfer assets to beneficiaries upon their death, avoiding probate. 2. Irrevocable trusts. Once established, the terms of these trusts generally cannot be changed, providing asset protection and potential tax benefits. Examples include irrevocable life insurance trusts, or ILITs, and charitable trusts. 3. Special needs trusts. Designed to provide for individuals with disabilities without jeopardizing their eligibility for government benefits. 4. Charitable trusts. Created to support charitable causes, providing tax benefits to the grantor and potential income to beneficiaries. 5. Asset protection trusts. These trusts shield assets from creditors and legal judgments, often used for wealth preservation and estate planning. 6. Spendthrift trusts. Offer protection against beneficiaries as creditors and their own mismanagement by limiting their access to trust assets. Trusts can be complex legal arrangements, and it's essential to work with legal and financial professionals to create one that aligns with your objectives and ensures the proper management and distribution of assets to beneficiaries. 2. Understanding hometown investments. Hometown investments typically refer to investments made in local businesses, projects, or initiatives within one's community or region. These investments aim to support local economic growth, create jobs, and foster development. They can take various forms, including 1. Small business investments. Investing in local startups or small businesses can provide capital for growth and expansion, contributing to the local economy and job creation. 2. Real estate development. Investing in local real estate projects such as commercial development or affordable housing can enhance the infrastructure and livability of the community. 3. Community development projects. Funding initiatives such as infrastructure improvements, community centers, or renewable energy projects can have a direct impact on the well-being of residents and the overall quality of life in the area. 4. Local financial institutions. Supporting local banks or credit unions through deposits or investments helps ensure access to financial services for residents and businesses within the community. 5. Social impact investments. Investing in social enterprises or nonprofits addressing local challenges such as education, healthcare, or environmental conservation can generate both financial returns and positive social outcomes. Hometown investments offer individuals the opportunity to align their financial goals with their values and contribute to the prosperity of their community. However, like any investment, it's essential to conduct thorough research, assess risks, and seek professional advice to make informed decisions. 3. Mutual Funds 101. Mutual funds are investment vehicles that pool money from multiple investors to purchase a diversified portfolio of stocks, bonds, or other securities. Here's a basic overview. 1. Diversification. By pooling funds from many investors, mutual funds can spread risk across a variety of investments. This diversification helps reduce the impact of any single investment's performance on the overall portfolio. 2. Professional management. Mutual funds are managed by professional portfolio managers who make investment decisions on behalf of investors. These managers conduct research, analyze market trends, and select securities to achieve the fund's objectives. 3. Variety of options. Mutual funds come in various types, including stock funds, bond funds, balanced funds, mix of stocks and bonds, index funds, tracking a specific market index, and sector funds, investing in specific industries. 4. Liquidity. Investors can typically buy and sell mutual fund shares on any business day at the fund's net asset value, or NAV, which is calculated at the end of each trading day. 5. Affordability. Many mutual funds have relatively low minimum investment requirements, making them accessible to a wide range of investors. Investors can also benefit from economies of scale, as mutual funds can negotiate lower trading costs compared to individual investors. 6. Transparency. Mutual funds are required to disclose their holdings, performance, fees, and other relevant information to investors regularly. This transparency allows investors to make informed decisions about their investments. 7. Fees. Mutual funds charge fees, including management fees for fund management, administrative fees for record keeping and shareholder services, and other expenses. These fees can vary widely among funds and can impact overall returns. Before investing in mutual funds, it's essential to consider factors such as your investment goals, risk tolerance, time horizon, and fees. Additionally, carefully review the fund's prospectus, which provides detailed information about its investment strategy, risks, fees, and historical performance. Consulting with a financial advisor can also help you make informed decisions based on your individual financial situation and goals. 4. Types of trust funds. Trust funds encompass a diverse array of legal arrangements designed to fulfill specific purposes and meet the unique needs of the grantor and beneficiaries involved. One prevalent type is the revocable living trust, offering flexibility and control during the grantor's lifetime. This trust allows assets to be managed and distributed according to the grantor's wishes, typically transitioning to beneficiaries seamlessly upon the grantor's death, bypassing the probate process and ensuring privacy. Conversely, irrevocable trusts are established with fixed terms that cannot be altered once set in motion. While relinquishing control, these trusts provide asset protection and potential tax advantages. Irrevocable life insurance trusts, or ILITs, and charitable trusts exemplify this category, offering avenues for estate planning, tax minimization, and philanthropy. Special needs trusts are tailored to support individuals with disabilities without jeopardizing their eligibility for government benefits. These trusts provide for supplemental care and quality of life enhancements while preserving essential support programs. Charitable trusts serve philanthropic goals by supporting charitable causes and organizations. They offer tax benefits to the grantor while facilitating ongoing contributions to meaningful endeavors, leaving a lasting impact on society. Asset protection trusts shield assets from creditors and legal judgments, safeguarding wealth for future generations. These trusts are commonly utilized for estate planning purposes, particularly in jurisdictions with favorable asset protection laws. Spendthrift trusts are designed to protect beneficiaries from their own financial mismanagement or external creditors. By limiting access to trust assets and providing oversight through a trustee, these trusts ensure the long-term financial security of beneficiaries. Each type of trust fund presents its own set of advantages and considerations, requiring careful consideration of legal, financial, and personal factors. Working with knowledgeable professionals can help navigate the complexities of trust fund establishment and management, ensuring alignment with the grantor's objectives and the well-being of beneficiaries. 5. How to establish a trust fund. Establishing a trust fund is a comprehensive process that involves several critical steps to ensure its effectiveness and legality. Firstly, you need to clearly define the objectives of the trust fund, including identifying beneficiaries and outlining how assets will be managed and distributed. Next, select a trustee who will be responsible for administering the trust and carrying out your wishes. This individual or entity should be trustworthy, competent, and willing to fulfill their fiduciary duties. Choose the assets you want to transfer into the trust, which could include cash, investments, real estate, or other valuable property. Work with a qualified attorney experienced in estate planning and trust law to draft a comprehensive trust document. This legal document will outline the terms and conditions of the trust, including its purpose, beneficiary provisions, trustee powers, and distribution instructions. Once the trust document is finalized, sign it in the presence of a notary public and transfer ownership of assets into the trust according to the document's instructions. Ensure that all legal requirements are met, such as filing necessary paperwork with government authorities or recording real estate deeds to formalize the establishment of the trust. Notify beneficiaries of the trust's existence, their rights, and how distributions will be made to them. Finally, actively manage the trust assets and monitor the trustee's performance to ensure that the trust continues to align with your intentions and objectives over time. Regularly review the trust document and make any necessary updates or amendments as circumstances change. Establishing a trust fund requires careful planning and execution, so it's crucial to seek guidance from legal and financial professionals throughout the process. 6. Benefits and risks of trust funds. Trust funds offer various benefits, but they also come with risks. Benefits. 1. Asset management. Trusts allow for professional management of assets by a trustee, ensuring they are invested prudently and distributed according to the grantor's wishes. 2. Estate planning. Trusts can facilitate the efficient transfer of wealth to beneficiaries, potentially minimizing estate taxes and avoiding probate, thereby preserving privacy and reducing administrative costs. 3. Asset protection. Certain types of trusts, such as irrevocable trusts, provide protection against creditors and legal judgments, shielding assets for future generations. 4. Control. Trusts allow grantors to specify how and when assets are distributed to beneficiaries, enabling control over their inheritance even after death. 5. Special needs planning. Special needs trusts enable individuals with disabilities to receive financial support without jeopardizing eligibility for government benefits. Risks. 1. Costs. Establishing and maintaining a trust can involve significant costs, including legal fees, trustee fees, and administrative expenses, which may outweigh the benefits for smaller estates. 2. Loss of control. Once assets are transferred into a trust, the grantor relinquishes control over them, which may be a concern if circumstances change or if the trustee does not fulfill their duties adequately. 3. Complexity. Trusts can be complex legal instruments, requiring careful planning and ongoing management. Misunderstandings or mistakes in trust administration can lead to disputes or unintended consequences. 4. Tax implications. While trusts can offer tax benefits, they also come with tax considerations, including income taxes on trust earnings and potential generation-skipping transfer taxes for certain types of trusts. 5. Market risk. Trust assets are subject to market fluctuations and investment risks, and poor investment decisions by the trustee could result in losses for beneficiaries. Ultimately, the decision to establish a trust fund should be based on careful consideration of the potential benefits and risks, as well as the specific needs and goals of the grantor and beneficiaries involved. Seeking guidance from legal and financial professionals can help mitigate risks and ensure that trusts are structured effectively to achieve their intended objectives. 7. Diversifying your investments. Diversifying your investments is like building a strong foundation for your financial future. It's about spreading your money across different types of assets, like stocks, bonds, real estate, and commodities, to reduce the impact of any single investment's poor performance on your overall portfolio. By diversifying, you're not putting all your eggs in one basket. Instead, you're spreading your risk and increasing the likelihood of achieving stable returns over time. For example, while stocks may offer higher potential returns, bonds can provide stability during market downturns. Real estate investments can offer steady income, while commodities like gold can serve as a hedge against inflation. Diversification also allows you to take advantage of opportunities in various sectors and markets. When one sector is struggling, others may be thriving, balancing out your overall investment performance. This can help smooth out the ups and downs of the market and reduce volatility in your portfolio. Moreover, diversification gives you the flexibility to tailor your investments to your individual financial goals and risk tolerance. You can adjust the mix of assets based on factors like your investment horizon, financial objectives, and comfort level with risk. Ultimately, diversifying your investments is a smart strategy for managing risk, maximizing returns, and building long-term wealth. It's essential to regularly review your portfolio and make adjustments as needed to ensure you maintain a well-diversified and balanced investment strategy. Diversifying your investments is a crucial strategy to manage risk and maximize potential returns in your portfolio. Here's an overview of diversification and its importance. 1. Definition. Diversification is the practice of spreading your investments across different asset classes, industries, geographies, and investment vehicles to reduce the overall risk exposure of your portfolio. 2. Importance of diversification. A. Risk reduction. By investing in a variety of assets that are not perfectly correlated, you minimize the impact of any single investment or market sector's performance on your overall portfolio. B. Potential for higher returns. Diversification allows you to capture opportunities across different markets and asset classes, potentially enhancing your portfolio's overall return. C. Weathering market volatility. A well-diversified portfolio can help mitigate the effects of market fluctuations and economic cycles on your investments. 3. Asset classes for diversification. A. Stocks. Invest in different sectors, industries, market capitalizations, and geographical regions. B. Bonds. Consider government bonds, corporate bonds, municipal bonds, and international bonds with varying maturities and credit ratings. C. Real estate. Invest in real estate investment trusts, or REITs, rental properties, or real estate crowdfunding platforms. D. Commodities. Precious metals, energy, agriculture, and other natural resources. E. Alternative investments. Hedge funds, private equity, venture capital, and other alternative investment vehicles. 4. Investment vehicles. A. Mutual funds and exchange-traded funds, or ETFs, can provide diversification within a single investment. B. Individual stocks, bonds, and other securities can be combined to create a diversified portfolio. 5. Strategies for diversification. A. Asset allocation. Determine the appropriate mix of asset classes based on your risk tolerance, investment horizon, and financial goals. B. Rebalancing. Periodically review and adjust your portfolio to maintain your desired asset allocation. C. Geographic diversification. Invest in different countries and regions to reduce exposure to any single market or economy. D. Sector diversification. Invest in various industries and sectors to mitigate industry-specific risks. 6. Considerations. A. Diversification does not guarantee against losses. It aims to manage risk. B. Over-diversification can lead to reduced returns and increased costs. C. Regularly review and adjust your portfolio to maintain an appropriate level of diversification. Remember, the key to successful diversification is finding the right balance between risk and potential returns based on your individual financial goals and risk tolerance. Consulting with a professional financial advisor can help you develop a well-diversified investment portfolio tailored to your specific needs. 8. Choosing the right mutual fund. Choosing the right mutual fund requires careful consideration of several factors to align with your financial goals, risk tolerance, and investment preferences. Firstly, assess your investment objectives and time horizon. Are you investing for retirement, education, or a short-term goal? Understanding your goals will help determine the appropriate mutual fund categories and investment strategies. Next, consider your risk tolerance. Are you comfortable with the potential volatility of stocks, or do you prefer more stable investments like bonds? Mutual funds come in various risk levels, from conservative bond funds to aggressive growth funds, so choose one that matches your risk profile. Evaluate the fund's investment strategy and objectives. Does it align with your investment goals and preferences? For example, if you're seeking long-term growth, look for funds with a track record of strong performance in growth-oriented sectors. Research the fund manager's experience and track record. A skilled and experienced manager can make a significant difference in fund performance over time. Look for managers with a consistent investment approach and a history of outperforming their benchmarks. Consider the fund's fees and expenses. While fees shouldn't be the sole determining factor, they can impact your investment returns over time. Compare expense ratios, sales charges or loads, and other fees to ensure they're reasonable relative to the fund's performance and services offered. Review the fund's historical performance, but don't rely solely on past returns to predict future performance. Look for consistent, long-term performance relative to its benchmark and peers rather than short-term fluctuations. Examine the fund's holdings and portfolio composition. Ensure it provides adequate diversification across different asset classes, industries, and regions. Avoid funds with concentrated holdings or excessive risk exposure. Lastly, consider factors like tax efficiency, fund size, and the quality of shareholder services. A tax-efficient fund can minimize taxes on distributions, while a well-managed fund with good shareholder services can enhance your overall investing experience. Summarized, choosing the right mutual fund involves conducting thorough research, seeking professional advice when needed, and selecting funds that align with your investment objectives, risk tolerance, and preferences. Regularly review your portfolio and make adjustments as needed to ensure it remains in line with your financial goals and evolving needs. 9. Investing strategies for beginners. Investing strategies for beginners involve starting with education, setting clear goals, and beginning with small investments. Diversification, low-cost index funds or ETFs, regular investing, and staying invested for the long term are key principles. Reinvesting dividends, monitoring and reviewing regularly, and seeking professional advice when needed round out a comprehensive approach to building wealth over time. Here are some effective investing strategies for beginners. 1. Start with a robust emergency fund. Before investing, build an emergency fund with 3 to 6 months' worth of living expenses in a liquid, low-risk account like a savings account or money market fund. This provides a safety net for unexpected expenses. 2. Pay off high-interest debt. Paying off debts with high interest rates can provide better returns than most investments. Prioritize eliminating credit card balances and other costly debts before investing. 3. Take advantage of tax-advantaged accounts. Contribute to retirement accounts like 401ks and IRAs to benefit from tax-deferred or tax-free growth. These accounts can be a great way for beginners to start investing. 4. Invest in low-cost index funds. Index funds provide broad diversification and low fees, making them an excellent choice for beginners. Consider index funds that track the S&P 500 or total stock market indexes. 5. Use a robo-advisor. Robo-advisors are automated investment platforms that build and manage a diversified portfolio based on your risk tolerance and goals. They offer a low-cost and hands-off approach for beginners. 6. Dollar cost averaging. Instead of investing a lump sum, consider dollar cost averaging by investing a fixed amount at regular intervals, e.g. monthly or quarterly. This can help reduce the impact of market volatility. 7. Diversify across asset classes. Don't just invest in stocks. Diversify your portfolio by including bonds, real estate investment trusts or REITs, and other asset classes to balance risk and returns. 8. Start small and invest consistently. Don't feel like you need a large sum to begin investing. Start small and invest consistently, even if it's just a few dollars from each paycheck. This habit can help build wealth over time. 9. Educate yourself. Read books, articles, and online resources to learn about investing concepts, strategies, and potential pitfalls. Knowledge empowers better decision-making. 10. Consider target date funds. If you're investing for retirement, target date funds can be a simple, hands-off approach. These funds automatically adjust asset allocation as you near your target retirement date. Remember, investing involves risks, and it's essential to understand your risk tolerance and investment horizon. Consider seeking guidance from a financial advisor, especially when starting, to develop a personalized investment strategy aligned with your goals. 10. Tax considerations and trust funds. Tax considerations play a significant role in the establishment and management of trust funds. Here's how taxes impact trust funds. 1. Income tax. Trusts are subject to income tax on the income they generate, such as interest, dividends, and capital gains. The tax rate applied depends on the type of trust and its income distribution rules. Revocable living trusts are typically taxed as grantor trusts, meaning the grantor is responsible for paying taxes on trust income. In contrast, irrevocable trusts are separate taxable entities and may be subject to higher tax rates. 2. Capital gains tax. When assets held in a trust are sold for profit, capital gains tax may apply. The tax rate depends on the length of time the asset was held, short-term or long-term, and the applicable tax brackets. 3. Trust distribution tax. Distributions from trusts to beneficiaries may be subject to income tax, depending on the nature of the distribution. For example, distributions of trust income are typically taxed to beneficiaries as ordinary income, while distributions of principal may have different tax treatment. 4. Estate tax. Trusts can be used as estate planning tools to minimize estate taxes upon the grantor's death. Assets transferred to certain types of irrevocable trusts may be removed from the grantor's taxable estate, reducing potential estate tax liabilities. 5. Gift tax. Transfers of assets into irrevocable trusts may be subject to gift tax if they exceed the annual gift tax exclusion amount. However, certain types of trusts, such as qualified personal residence trusts or QPRTs, or charitable remainder trusts or CRTs, may offer tax advantages and exemption from gift tax. 6. Generation skipping transfer tax or GSTT. Trusts designed to benefit multiple generations, such as generation skipping trusts, may be subject to GSTT to prevent the avoidance of estate taxes through successive generations. 7. State taxes. Trusts may also be subject to state income tax, depending on the state's tax laws and the location of the trust assets and beneficiaries. Navigating the complex tax implications of trust funds requires careful planning and professional guidance. Working with experienced tax advisors and estate planning attorneys can help minimize tax liabilities and ensure compliance with applicable tax laws. 11. Monitoring and managing your investments. Monitoring and managing your investments is crucial for maintaining a healthy portfolio and achieving your financial goals. Here's how to effectively monitor and manage your investments. 1. Regular review. Set aside time at regular intervals to review your investment portfolio. This could be monthly, quarterly, or annually, depending on your preferences and the complexity of your investments. 2. Evaluate performance. Assess the performance of each investment in your portfolio relative to its objectives, benchmarks, and your overall investment goals. Look at both short-term and long-term performance to identify trends and patterns. 3. Rebalance. Periodically rebalance your portfolio to ensure it remains aligned with your target asset allocation and risk tolerance. Rebalancing involves selling overperforming assets and buying underperforming ones to maintain your desired asset mix. 4. Stay informed. Stay informed about market developments, economic trends, and changes in investment fundamentals that may impact your portfolio. Regularly read financial news, research reports, and economic indicators to stay abreast of relevant information. 5. Diversification. Monitor the diversification of your portfolio across different asset classes, sectors, industries, and geographic regions. Ensure you have adequate exposure to different types of investments to reduce risk and capture opportunities. 6. Review fees and expenses. Pay attention to the fees and expenses associated with your investments, including management fees, expense ratios, and transaction costs. Minimize costs where possible to enhance your investment returns. 7. Tax management. Consider the tax implications of your investment decisions and strategies. Look for opportunities to minimize taxes through tax-efficient investment vehicles, tax loss harvesting, and strategic asset location. 8. Stay disciplined. Avoid making impulsive investment decisions based on short-term market movements or emotional reactions. Stick to your long-term investment plan and resist the temptation to chase hot tips or follow the crowd. 9. Document changes. Keep detailed records of any changes or decisions made regarding your investments, including trades, rebalancing actions, and adjustments to your investment strategy. This documentation can help track your progress and inform future decisions. 10. Seek professional advice. Consider seeking advice from a financial advisor or investment professional, especially for complex investment strategies or during periods of uncertainty. A qualified advisor can provide personalized guidance tailored to your individual financial situation and goals. By regularly monitoring and managing your investments, you can optimize your portfolio's performance, mitigate risks, and stay on track to achieve your financial objectives over time. 12. Ethical considerations in trust fund investments. Ethical considerations in trust fund investments involve conscientiously aligning investment decisions with values that prioritize social responsibility, environmental sustainability, and ethical practices. To ensure ethical alignment, trustees should establish clear criteria that guide investment decisions. This may involve negative screening, which excludes investments in industries or companies that conflict with ethical values, such as tobacco, weapons, or companies with poor environmental records. Conversely, trustees may seek out investments that demonstrate strong environmental, social, and governance practices, promoting positive impact and sustainability. Engagement with companies and stakeholders is crucial in advocating for positive change. Trustees can use their shareholder rights to influence corporate behavior, such as voting on shareholder resolutions and engaging with management on environmental, social, and governance, or ESG, issues. This proactive approach encourages greater transparency, accountability, and responsible business practices. Furthermore, trustees should prioritize impact investing, allocating capital to investments that generate measurable social or environmental benefits alongside financial returns. By supporting initiatives like renewable energy, affordable housing, or healthcare access, trust funds can contribute to addressing pressing societal challenges while achieving financial objectives. Continuous evaluation of investments is essential to ensure ongoing ethical alignment. Trustees should regularly monitor ESG factors, company practices, and societal trends, adjusting the investment strategy as needed to maintain ethical integrity and maximize positive impact. Transparency and reporting are paramount in ethical investing. Trustees should provide stakeholders with clear and comprehensive information about investment decisions, ESG considerations, and the impact of investments on society and the environment. This transparency fosters trust and accountability, reinforcing the commitment to ethical investing principles. Seeking guidance from ethical investment professionals or advisors can help trustees navigate the complexities of ethical investing and identify suitable opportunities that align with their values and objectives. By integrating ethical considerations into trust fund investments, trustees can fulfill their fiduciary duties while contributing to positive social and environmental outcomes. 13. Future trends in trust funds. In the evolving landscape of trust funds, several trends are poised to shape their future trajectory. One significant trend is the increasing emphasis on sustainable and responsible investing. Trustees are likely to prioritize environmental, social, and governance or ESG factors in investment decisions, reflecting a growing awareness of the importance of sustainability and ethical considerations. Moreover, impact investing is expected to gain momentum, with trust funds allocating capital to investments that generate positive social or environmental impact alongside financial returns. This trend reflects a broader shift towards investments that address pressing societal challenges such as climate change, healthcare access, and education. Technology is also set to play a pivotal role in the future of trust funds. Advancements in digital platforms, data analytics, and artificial intelligence are transforming how trust funds are managed, administered, and accessed by beneficiaries. Trustees may leverage technology to provide personalized investment advice, streamline administrative processes, and enhance transparency and reporting. Furthermore, intergenerational wealth transfer will shape the evolution of trust funds. As wealth passes between generations, trustees may need to adapt to the changing preferences and priorities of younger beneficiaries. This could involve offering more flexible and dynamic structures that cater to the unique needs of future generations. Estate planning and tax optimization will remain key considerations for trust funds, particularly as tax laws and regulations evolve. Trustees may explore innovative strategies to minimize tax liabilities and preserve wealth for beneficiaries while ensuring compliance with regulatory requirements. Additionally, there may be a growing emphasis on transparency, accountability, and governance in trust fund management. Trustees will need to enhance reporting practices and communication with beneficiaries to foster trust and confidence in the management of trust assets. Overall, future trends in trust funds are likely to be influenced by a combination of societal, technological, regulatory, and economic factors. Trustees will need to stay informed and adaptable to navigate these trends and meet the evolving needs and expectations of grantors and beneficiaries in an increasingly complex and dynamic environment. 14. Conclusion. In conclusion, trust funds are evolving to meet the changing needs and expectations of grantors and beneficiaries in today's dynamic financial landscape. Key trends shaping the future of trust funds include a growing emphasis on sustainable and responsible investing, increased focus on impact investing, technological advancements driving digital transformation, and intergenerational wealth transfer reshaping beneficiary preferences. Moreover, estate planning, tax optimization, transparency, accountability, and governance remain paramount considerations for trustees. By staying informed and adaptable to these trends, trustees can effectively navigate the evolving landscape of trust funds and ensure they continue to serve as effective vehicles for wealth preservation, asset management, and legacy planning for generations to come. You have been listening to Trust Funds, Hometown Investments and Mutual Funds for Beginners. Written by Daniel Shore. Narrated by Jacob Simmons. Reverse mortgage, leverage home equity, the appraised value, and asset-backed securities. Written by Daniel Shore. Narrated by Jacob Simmons. 1. Introduction to reverse mortgages. A reverse mortgage allows homeowners aged 62 or older to access a portion of the equity they have built up in their homes over the years. The amount that can be borrowed depends on factors such as the homeowner's age, the appraised value of the home, and current interest rates. One of the key features of a reverse mortgage is that it does not require monthly payments like a traditional mortgage does. Instead, the loan balance increases over time as interest accrues on the borrowed amount. The homeowner retains ownership of the home and can continue to live in it as long as they comply with the loan terms, which typically include maintaining the property and paying property taxes and homeowners insurance. Repayment of the loan is usually deferred until the homeowner moves out of the home permanently, sells the home, or passes away. At that point, the loan must be repaid, usually through the sale of the home. Any remaining equity after the loan is repaid belongs to the homeowner or their heirs. Reverse mortgages can be a valuable financial tool for seniors who need additional income during retirement or want to access their home equity without selling their home. However, they also come with certain risks and considerations, such as potential fees, interest rates, and the impact on inheritances. It's essential for homeowners to carefully consider their options and consult with a financial advisor before deciding if a reverse mortgage is right for them. 2. Understanding home equity. Home equity refers to the value of ownership that homeowners have built up in their homes through payments and appreciation over time. It's essentially the difference between the current market value of the property and the outstanding balance on any mortgage or other debts secured by the property. For example, if your home is worth $300,000 on the market and you owe $200,000 on your mortgage, you have $100,000 in home equity. Home equity can increase in two primary ways: through paying down the mortgage principal and through appreciation of the property's value. When you make mortgage payments, a portion goes towards reducing the loan balance or the principal, which increases your equity. Additionally, if the value of your home increases due to factors like market conditions, or home improvements, your equity grows as well. Home equity is an important financial asset that homeowners can tap into through options like home equity loans, home equity lines of credit or HELOCs, or reverse mortgages. It can also be a valuable source of wealth and financial security, providing opportunities for things like renovations, debt consolidation, or retirement funding. However, it's crucial to manage home equity responsibly to avoid over-leveraging or risky foreclosure. Home equity is a crucial concept for homeowners to understand, as it represents the portion of their property's value that they truly own. Here's an overview of home equity. 1. Definition. Home equity is the difference between the current market value of a home and the outstanding balance on any mortgages or loans secured against the property. 2. Building equity. There are two primary ways for homeowners to build equity. A. Principal repayment. With each mortgage payment, a portion goes towards paying off the principal loan balance, increasing the homeowner's equity stake. B. Property value appreciation. As the property's market value rises over time, the homeowner's equity also increases. 3. Equity position. Homeowners can be in different equity positions. A. Positive equity. When the home's market value exceeds the mortgage balance, the homeowner has positive equity. B. Negative equity, or underwater. When the mortgage balance is higher than the home's value, the homeowner has negative equity. 4. Importance of home equity. A. Wealth building. Home equity represents a significant portion of many households' net worth and can be a source of long-term wealth. B. Borrowing power. Homeowners with substantial equity can access home equity loans or lines of credit, using their equity as collateral for borrowing funds. C. Financial security. Equity provides a cushion during economic downturns or emergencies, allowing homeowners to tap into their home's value if needed. 5. Accessing home equity. A. Cash out refinance. Refinancing a mortgage for a higher amount than the outstanding balance, receiving the difference in cash. B. Home equity loan. A lump sum loan secured against the home's equity, typically with a fixed interest rate and repayment term. C. Home equity line of credit, or HELOC. A revolving line of credit secured by the home's equity, allowing borrowing as needed up to a set limit. 6. Risks and considerations. A. Market fluctuations. Home values can decline, reducing or eliminating equity, especially during housing market downturns. B. Debt burden. Tapping into home equity increases debt obligations, which can be risky if not managed responsibly. C. Foreclosure risk. Failure to repay loans secured against the home's equity could result in foreclosure. Understanding and building home equity is essential for homeowners as it represents a valuable asset and potential source of funds. However, it's crucial to approach equity utilization cautiously and ensure it aligns with long-term financial goals and risk tolerance. 3. The appraisal process. The appraisal process is a critical step in buying or refinancing a home. Here's an overview. 1. Selection of an appraiser. Lenders typically select a licensed or certified appraiser who is independent and has no vested interest in the property. The appraiser's role is to provide an unbiased opinion of the property's value. 2. Property inspection. The appraiser visits the property to conduct a thorough inspection. They assess factors such as the home's condition, size, layout, features, and any improvements or renovations. 3. Comparative market analysis, or CMA. The appraiser compares the property to similar homes, comparables, recently sold in the area to determine its market value. They consider factors like location, size, age, and the condition to make adjustments and arrive at a fair valuation. 4. Report preparation. After gathering all necessary information, the appraiser prepares a detailed report outlining their findings, methodology, and the final valuation of the property. 5. Review and submission. The lender reviews the appraisal report to ensure it meets their requirements and guidelines. Once approved, the appraisal is submitted as part of the loan process. 6. Use in loan approval. The appraisal plays a crucial role in the loan approval process. Lenders use the appraised value to determine the maximum loan amount they are willing to provide, as well as to ensure the property serves as adequate collateral for the loan. Overall, the appraisal process helps ensure that buyers, sellers, and lenders have an accurate understanding of a property's value, which is essential for making informed decisions in real estate transactions. 4. Exploring asset-backed securities. Asset-backed securities, or ABS, are financial instruments backed by a pool of underlying assets, such as loans, leases, or receivables. These assets generate cash flows that are used to repay investors who hold the securities. Financial institutions bundle together various types of assets, such as auto loans, credit card receivables, or mortgages, into a single pool. This diversification helps spread risk across different types of assets and borrowers. The pooled assets are divided into different tranches, each with its own risk and return characteristics. Senior tranches are typically safer and have priority in receiving cash flows, while junior tranches carry higher risk but offer potentially higher returns. The asset pool is then transferred to a special purpose vehicle, or SPV, which issues securities backed by the cash flows from the underlying assets. These securities are sold to investors in the capital markets. The cash flows generated by the underlying assets, such as loan repayments or interest payments, are passed through the SPV to investors in the form of principal and interest payments on the securities. To enhance the credit quality of ABS, various techniques may be used, such as over-collateralization, insurance, or reserve funds, to mitigate the risk of default on the underlying assets. ABS are typically assigned credit ratings by rating agencies based on the credit quality of the underlying assets, the structure of the transaction, and other factors. These ratings help investors assess the risk associated with the securities. Asset-backed securities are traded in the secondary market, providing investors with liquidity and the ability to buy and sell these securities after they have been issued. Asset-backed securities can offer investors the opportunity to gain exposure to a diversified pool of assets and potentially earn higher yields than traditional fixed income investments. However, they also carry risks, including credit risk, prepayment risk, and market risk. It's essential for investors to carefully evaluate the characteristics and risks of ABS before investing. 5. Historical context of reverse mortgages. Reverse mortgages have evolved over time, shaped by changes in economic conditions, housing markets, and government regulations. Here's a brief historical overview. 1. 1961. The concept of a reverse mortgage was first introduced in the United States by Nelson Haynes in his book Solid Ground. However, it wasn't until several decades later that reverse mortgages became widely available. 2. 1987. The first reverse mortgage program in the United States, called the Home Equity Conversion Mortgage, or HECM, was created by the Reagan administration. It was initially designed to help low-income seniors access their home equity without selling their homes. 3. 1990s. Reverse mortgages gained popularity during this decade as an increasing number of retirees sought ways to supplement their retirement income. Private lenders began offering proprietary reverse mortgage products alongside government-insured HECMs. 4. 2008 financial crisis. The housing market crash and financial crisis had a significant impact on reverse mortgages. Falling home values and tightened lending standards led to increased defaults and losses for lenders. 5. 2010. The Housing and Economic Recovery Act of 2008, or HERA, mandated several changes to the HECM program, including the introduction of financial assessments to ensure borrowers could afford property taxes and insurance. These changes aimed to strengthen the program and protect borrowers and lenders. 6. 2013. The introduction of the financial assessment rule required lenders to assess the financial capacity of prospective borrowers to meet their obligations under the reverse mortgage, such as property taxes and insurance. 7. 2020. The COVID-19 pandemic brought additional challenges to the reverse mortgage industry, including concerns about declining home values and the financial stability of older homeowners. Throughout its history, reverse mortgages have been subject to ongoing scrutiny and debate regarding their benefits, risks, and suitability for older homeowners. Government regulations, industry standards, and consumer protections continue to evolve to ensure the responsible and sustainable use of reverse mortgages as a financial tool for retirees. 6. Pros and cons of reverse mortgages. Here are the pros and cons of reverse mortgages. Pros. 1. Supplemental income. Reverse mortgages provide a way for older homeowners to access the equity in their homes, potentially providing additional income during retirement. 2. No monthly payments. Unlike traditional mortgages, reverse mortgage borrowers typically do not have to make monthly mortgage payments. Instead, the loan is repaid when the borrower moves out of the home or passes away. 3. Stay in your home. Reverse mortgages allow seniors to remain in their homes while accessing their equity, providing them with stability and independence. 4. Flexible payment options. borrowers can choose to receive funds from a reverse mortgage as a lump sum, a line of credit, fixed monthly payments, or a combination of these options. 5. Non-recourse loan. Reverse mortgages are typically non-recourse loans, meaning that borrowers or their heirs are not personally liable for any debt exceeding the value of the home at the time of repayment. Cons. 1. Accruing interest. Interest continues to accrue on the loan balance over time, potentially reducing the equity available to the borrower or their heirs when the loan is repaid. 2. Fees and costs. Reverse mortgages can come with significant upfront costs, including origination fees, closing costs, mortgage insurance premiums, and servicing fees, which can eat into the available equity. 3. Impact on inheritance. The equity in the home may be depleted over time, reducing the inheritance that borrowers can leave to their heirs. 4. Risk of foreclosure. Failure to meet the obligations of the reverse mortgage, such as paying property taxes and homeowners insurance, could lead to foreclosure and the loss of the home. 5. Complexity and risk. Reverse mortgages can be complex financial products with terms and conditions that may not be fully understood by borrowers. There is a risk of misunderstanding or mismanaging the loan, leading to financial consequences. It's essential for older homeowners considering a reverse mortgage to carefully weigh the pros and cons, consider their financial situation and goals, and seek guidance from a qualified financial advisor or housing counselor before making a decision. 7. Eligibility and qualifications. Eligibility and qualifications for a reverse mortgage typically include 1. Age. You must be at least 62 years old to qualify for a reverse mortgage. Younger spouses may be included on the loan if one borrower meets the age requirement. 2. Homeownership. You must own your home outright or have a low mortgage balance that can be paid off with the proceeds from the reverse mortgage. 3. Primary residence. The property must be your primary residence, meaning you live in it for the majority of the year. 4. Property type. Eligible properties include single-family homes, multi-unit properties up to 4 units, condominiums approved by the Federal Housing Administration or FHA, and manufactured homes that meet FHA requirements. 5. Financial assessment. Lenders will assess your financial situation, including credit history, income, and expenses, to ensure you can afford property taxes, homeowners insurance, and other ongoing expenses. 6. Counseling. Before obtaining a reverse mortgage, you must undergo counseling with an HUD-approved housing counselor. This counseling session provides information about reverse mortgages, alternatives, and the implications of the loan. 7. Loan limits. Reverse mortgages have loan limits based on the appraised value of the home and the borrower's age. The maximum amount you can borrow depends on these factors. 8. Non-borrowing spouse protections. If you have a non-borrowing spouse, they may be protected under certain circumstances, such as being listed as a non-borrowing spouse on the loan documents and meeting age and occupancy requirements. It's essential to carefully review the eligibility requirements and qualifications for a reverse mortgage and consider how the loan aligns with your financial goals and circumstances. Consulting with a qualified financial advisor or housing counselor can help you make an informed decision. 8. Types of reverse mortgages. There are several types of reverse mortgages, each designed to meet different needs and preferences of homeowners. Here are the main types. 1. Home Equity Conversion Mortgage, or HECM. HECM is the most common type of reverse mortgage and is insured by the Federal Housing Administration, or FHA. It offers flexible payment options, including lump sum, line of credit, monthly payments, or a combination. Borrowers must meet certain eligibility requirements, including age, occupancy, and financial assessment. 2. Proprietary reverse mortgage. These are private reverse mortgages offered by financial institutions and are not insured by the FHA. They may have higher loan limits and offer different features than HECMs, but eligibility requirements and terms can vary by lender. 3. Single-purpose reverse mortgage. These are offered by state and local government agencies, as well as nonprofit organizations, and are typically used for specific purposes, such as home repairs or property taxes. They often have lower costs but may have restrictions on how the funds can be used. 4. Reverse mortgage for purchase. This type of reverse mortgage allows seniors to purchase a new primary residence using the proceeds from the reverse mortgage. It can be a useful option for downsizing or relocating in retirement. Each type of reverse mortgage has its own eligibility criteria, costs, and features, so it's essential for homeowners to carefully evaluate their options and choose the one that best fits their needs and financial situation. Consulting with a qualified financial advisor or housing counselor can provide additional guidance in selecting the right type of reverse mortgage. 9. How reverse mortgages work. Reverse mortgages work by allowing homeowners aged 62 or older to access a portion of their home equity without having to sell their home or make monthly mortgage payments. Here's how they work. 1. Loan origination. The homeowner applies for a reverse mortgage through a lender. The lender evaluates factors such as the homeowner's age, the value of the home, and current interest rates to determine the loan amount. 2. Loan disbursement. Once approved, the homeowner can receive the funds from the reverse mortgage in various ways, such as a lump sum, monthly payments, a line of credit, or a combination of these options. 3. No monthly payments. Unlike traditional mortgages, reverse mortgage borrowers typically do not have to make monthly mortgage payments to the lender. Instead, the loan balance accumulates over time as interest accrues on the borrowed amount. 4. Interest and fees. Interest is charged on the outstanding loan balance, and fees such as origination fees, closing costs, and mortgage insurance premiums may also apply. These costs are typically added to the loan balance and repaid when the loan is settled. 5. Loan repayment. The reverse mortgage loan must be repaid when the homeowner moves out of the home permanently, sells the home, or passes away. At that point, the loan balance, including accrued interest and fees, is typically paid off using the proceeds from the sale of the home. 6. Remaining equity. Any remaining equity after the reverse mortgage is repaid belongs to the homeowner or their heirs. If the home is sold for more than the loan balance, the excess proceeds go to the homeowner or their estate. 7. Non-recourse loan. Reverse mortgages are typically non-recourse loans, meaning that the homeowner or their heirs are not personally liable for any debt exceeding the value of the home at the time of repayment. If the home is sold for less than the loan balance, the lender absorbs the loss. It's important for homeowners considering a reverse mortgage to carefully review the terms, costs, and implications of the loan, as well as explore alternative options and consult with a qualified financial advisor or a housing counselor before making a decision. 10. Financial planning with reverse mortgages. Financial planning with reverse mortgages involves a thorough examination of how this financial tool fits into an individual's overall retirement strategy. Here's a narrative breakdown. Reverse mortgages can serve as a valuable resource for retirees seeking to supplement their income. By tapping into their home equity without the need to sell their property, retirees can potentially improve their cash flow during their golden years. Financial planners play a crucial role in assessing whether a reverse mortgage aligns with a client's retirement income needs and goals. They carefully analyze factors such as the client's age, home value, and existing financial obligations to determine the suitability of a reverse mortgage. One key aspect of financial planning with reverse mortgages is cash flow management. Financial planners work closely with clients to develop a strategy for utilizing the proceeds from a reverse mortgage. Whether through lump sum payments, monthly installments, lines of credit, or a combination, planners help clients optimize the use of these funds to cover ongoing expenses, repay debts, or invest for the future. Long-term care planning is another critical consideration. Reverse mortgages can offer a means to finance expenses related to aging in place, such as home modifications or in-home care services. Financial planners evaluate clients' long-term care needs and incorporate reverse mortgages into their planning strategy accordingly, taking into account eligibility requirements, costs, and potential impact on other retirement assets. Debt management is also part of the equation. Reverse mortgages can be used to consolidate high-interest debt, providing relief for retirees burdened by credit card bills or medical expenses. Planners assess whether debt consolidation through a reverse mortgage is a prudent option, considering the overall financial picture and potential long-term implications. Estate planning considerations are paramount when exploring reverse mortgages. Planners help clients understand how this financial tool may impact their estate, including implications for heirs and estate distribution. By examining various scenarios and strategies, planners ensure that clients make informed decisions that align with their estate planning goals. Risk management is another area of focus. While reverse mortgages offer benefits, they also come with risks, such as accruing interest and fees, and the potential depletion of home equity over time. Planners help clients navigate these risks by analyzing factors such as interest rates, home appreciation, and loan repayment options. Ultimately, financial planning with reverse mortgages requires a holistic approach that considers the client's unique circumstances, goals, and preferences. By working closely with a qualified financial planner, retirees can make informed decisions about how to incorporate reverse mortgages into their retirement strategy and achieve financial security in their later years. 11. Common misconceptions and myths. Reverse mortgages are often misunderstood, leading to common misconceptions. Some believe they result in loss of ownership, high fees, or negative equity. But in reality, homeowners retain ownership, fees are comparable to traditional mortgages, and non-recourse loans protect against negative equity. Other myths include misconceptions about impact on benefits, foreclosure risks, and limited use of funds. It's crucial to separate fact from fiction and seek accurate information when considering a reverse mortgage. Here are some common misconceptions and myths about reverse mortgages. 1. Myth: the bank owns your home after getting a reverse mortgage. Reality: you maintain ownership and can live in your home as long as you meet the loan obligations like paying property taxes and insurance. 2. Myth: you can't leave your home to your heirs. Reality: you can leave the remaining equity or value to your heirs after repaying the reverse mortgage loan balance when you move out or pass away. 3. Myth: reverse mortgages are a last resort for cash-strapped seniors. Reality: reverse mortgages can be a useful financial planning tool for seniors to access home equity while aging in place. 4. Myth: all reverse mortgages are the same. Reality: there are different reverse mortgage products, HECM, proprietary, with varying eligibility criteria, costs, and terms. 5. Myth: you can borrow the full value of your home. Reality: the loan amount depends on your age, home value, and the interest rate charged. Most only let you borrow a portion. 6. Myth: you don't have to pay reverse mortgage loans back. Reality: the loan balance, including interest and fees, must eventually be repaid, typically when you move out, sell the home, or pass away. 7. Myth: reverse mortgages are too expensive due to high upfront costs. Reality: costs can be recouped over time as you access equity. The long-term benefits may outweigh upfront expenses. 8. Myth: reverse mortgages are only for low-income seniors. Reality: eligibility is based on age, 62 plus, and home equity rather than income level. 9. Myth: getting a reverse mortgage affects Medicare or Medicaid eligibility. Reality: reverse mortgage loan proceeds are considered loan advances, not income, so they generally don't impact these benefits. 10. Myth: all spouses must be 62 plus to qualify. Reality: with certain products, one spouse can be under 62 as long as the other meets the age requirement. Reverse mortgages can be complex products, so it's crucial to consult with a qualified housing counselor and carefully evaluate the suitability based on one's specific situation and goals. 12. Risks and considerations. When contemplating a reverse mortgage, it's vital to acknowledge the accompanying risks and considerations. Firstly, accrued interest poses a potential threat as it accumulates over time, potentially diminishing the equity accessible to the borrower or their heirs upon repayment. Secondly, there are substantial fees and costs associated with reverse mortgages, including origination fees, closing costs, mortgage insurance premiums, and servicing fees, which can erode available equity. Moreover, the utilization of a reverse mortgage may deplete the home's equity, impacting the inheritance that borrowers can leave for their heirs. There's also a risk of foreclosure if borrowers fail to meet their obligations, such as paying property taxes and homeowners insurance, potentially resulting in the loss of the home. Furthermore, reverse mortgages are intricate financial products, and misunderstanding or mismanaging them could lead to adverse financial outcomes. Interest rate fluctuations and market volatility can also influence the loan's cost and the amount of equity accessible to borrowers. Additionally, while reverse mortgage proceeds are typically not taxable income, they could affect eligibility for means-tested benefits, such as Medicaid or Supplemental Security Income, or SSI. Lastly, it's crucial to explore alternative options, such as downsizing or leveraging existing assets, before committing to a reverse mortgage. Thoughtful consideration and consultation with a qualified financial advisor or housing counselor are indispensable for comprehending and mitigating these risks, ensuring that a reverse mortgage aligns with one's financial objectives and circumstances. 13. Legal and ethical considerations. Legal and ethical considerations are paramount when it comes to reverse mortgages. Here's an overview without bullet points. Legally, it's crucial for borrowers to understand the terms and conditions of the reverse mortgage agreement, including their rights and responsibilities as outlined in the loan documents. This includes provisions regarding loan repayment, interest rates, fees, and the consequences of defaulting on the loan. From an ethical standpoint, lenders and loan officers must act in the best interests of the borrower, providing clear and accurate information about the loan terms, costs, and risks. They should ensure that borrowers fully understand the implications of a reverse mortgage and are aware of any alternatives that may better suit their needs. Financial advisors and housing counselors play a vital role in providing unbiased guidance and education to borrowers, helping them make informed decisions about reverse mortgages based on their individual circumstances and preferences. It's also important to consider the ethical implications of selling reverse mortgages to vulnerable populations, such as older adults with cognitive impairments or limited financial literacy. Lenders and professionals in the reverse mortgage industry should adhere to ethical standards and practices to protect vulnerable borrowers from exploitation or financial harm. Regulatory compliance is essential to ensure that reverse mortgage transactions comply with applicable laws and regulations, including consumer protection laws, fair lending practices, and disclosure requirements. Compliance helps safeguard borrowers' rights and ensures transparency and fairness in the lending process. 14. Future trends in reverse mortgages. Predicting future trends in reverse mortgages involves considering demographic shifts, regulatory changes, technological advancements, and evolving consumer preferences. Here's a narrative breakdown. As the population ages and more baby boomers reach retirement age, there is likely to be an increased demand for financial products that help seniors access their home equity. Reverse mortgages may become more popular as retirees seek ways to supplement their retirement income without selling their homes. Regulatory changes could shape the future of reverse mortgages, with policymakers implementing measures to enhance consumer protections, improve transparency, and ensure the sustainability of the program. This could include reforms to address issues such as loan affordability, borrower eligibility, and loan servicing practices. Technological advancements may streamline the reverse mortgage process, making it easier for borrowers to apply for and manage their loans online. Digital tools, such as mobile apps and online portals, could provide borrowers with greater access to information and resources, empowering them to make more informed decisions about reverse mortgages. There may also be a growing focus on financial education and counseling for reverse mortgage borrowers, helping them to understand the implications of the loan and explore alternative options. Financial advisors and housing counselors could play a more significant role in guiding retirees through the decision-making process and ensuring that reverse mortgages align with their long-term financial goals. Alternative equity release products may emerge as competitors to traditional reverse mortgages, offering new features, benefits, and pricing structures. These products could cater to different segments of the senior population and provide more flexibility and customization options for borrowers. 15. Conclusion. In conclusion, reverse mortgages represent a complex and evolving financial tool that can provide seniors with opportunities to access their home equity in retirement. However, they also come with risks and considerations that must be carefully weighed and understood. As the population ages and retirement needs evolve, reverse mortgages are likely to play an increasingly significant role in retirement planning. Moving forward, it's essential for stakeholders in the reverse mortgage industry, including borrowers, lenders, regulators, and financial professionals, to prioritize transparency, consumer protection, and regulatory compliance. By adhering to ethical standards, providing unbiased guidance, and promoting financial education, the industry can help ensure that reverse mortgages are used responsibly and effectively to meet the needs of retirees. As demographic shifts, technological advancements, and regulatory changes continue to shape the landscape of reverse mortgages, ongoing innovation and adaptation will be key. By staying informed, proactive, and responsive to emerging trends and consumer preferences, the reverse mortgage industry can continue to evolve and serve as a valuable resource for retirees seeking financial security and independence in their later years. You have been listening to Reverse Mortgage, Leverage Home Equity, the Appraised Value, and Asset-Backed Securities. Written by Daniel Shore. Narrated by Jacob Simmons. Business loans. Getting and using a loan for a small business. Written by Daniel Shore. Narrated by Jacob Simmons. 1. Introduction. In the dynamic world of entrepreneurship, access to capital is often the lifeblood of success. Whether you're launching a startup, expanding an existing venture, or weathering unforeseen challenges, securing the right business loan can be a crucial step towards achieving your goals. This book is designed to be your comprehensive guide through the intricate landscape of business lending. From understanding the different types of loans available, to navigating the application process and managing loan funds effectively, will walk you through every stage of the journey. Starting and running a small business is no small feat. It requires vision, determination, and, of course, financial resources. But with the right knowledge and preparation, obtaining and utilizing a business loan can become a strategic tool in your entrepreneurial arsenal. Whether you're a seasoned business owner or just starting out, this book aims to demystify the world of business loans, empowering you to make informed decisions that will propel your business forward. Let's embark on this journey together as we unlock the doors to financial opportunity and success for your small business. The importance of business loans. In the ever-evolving landscape of commerce, small businesses serve as the backbone of economies worldwide. They fuel innovation, create jobs, and drive economic growth. However, the journey of entrepreneurship is fraught with challenges, and one of the most significant hurdles for many small business owners is accessing the necessary capital to start, sustain, or expand their ventures. Business loans play a pivotal role in addressing this challenge by providing entrepreneurs with the financial resources they need to turn their visions into reality. Whether it's securing funds to launch a new product, expanding operations to new markets, or weathering unexpected downturns, the importance of business loans cannot be overstated. Here are a few key reasons why business loans are essential for small businesses. 1. Startup capital. For aspiring entrepreneurs, obtaining startup capital is often the first and most crucial step in bringing their business ideas to fruition. Business loans can provide the initial infusion of capital needed to cover essential expenses such as equipment purchases, inventory acquisition, and marketing efforts. 2. Expansion opportunities. As businesses grow and evolve, they may encounter opportunities to expand their operations, enter new markets, or diversify their product offerings. Business loans enable entrepreneurs to seize these opportunities by providing the necessary funding to fuel growth initiatives. 3. Cash flow management. Maintaining healthy cash flow is essential for the day-to-day operations of any business. Business loans can serve as a lifeline during periods of cash flow strain, ensuring that businesses have the liquidity needed to cover expenses such as payroll, rent, and utilities. 4. Investment in technology and innovation. In today's digital age, staying competitive often requires investments in technology and innovation. Whether it's upgrading to the latest software, implementing new manufacturing processes, or developing cutting-edge products, business loans can provide the capital needed to stay ahead of the curve. 5. Navigating economic challenges. Economic downturns, market fluctuations, and unforeseen crises can pose significant challenges for small businesses. Business loans can provide a safety net during tough times, enabling businesses to weather the storm and emerge stronger on the other side. In essence, business loans serve as a catalyst for growth, innovation, and resilience in the world of entrepreneurship. By providing entrepreneurs with the financial resources they need to pursue their ambitions, business loans play a vital role in driving economic prosperity and empowering small businesses to thrive in an increasingly competitive marketplace. Understanding the loan process. Navigating the business loan process can be complex and daunting, especially for those new to entrepreneurship or unfamiliar with financial terminology. However, with a clear understanding of the loan process, entrepreneurs can approach the journey with confidence and maximize their chances of securing the funding they need. Here's an overview of the key steps involved in the business loan process. 1. Assessing financial needs. The first step in the loan process is to assess your business's financial needs. Determine how much capital you require, what you will use it for, and how long you will need the funds. 2. Researching lenders. Once you have a clear understanding of your financial needs, research potential lenders who offer business loans. Consider factors such as interest rates, repayment terms, loan amounts, and eligibility criteria. 3. Gathering documentation. Lenders will require various documents to evaluate your loan application, including financial statements, tax returns, business plans, and proof of collateral. Gather all necessary documentation and ensure it is accurate and up to date. 4. Preparing the loan application. With your documentation in hand, complete the loan application according to the lender's requirements. Be thorough and provide all requested information to expedite the review process. 5. Submitting the application. Once your loan application is complete, submit it to the lender for review. Some lenders may offer online application portals, while others may require you to submit documents in person or via mail. 6. Underwriting process. After receiving your loan application, the lender will conduct a thorough review of your financial history, credit worthiness, and business viability. This process, known as underwriting, helps the lender assess the risk of extending credit to your business. 7. Loan approval or denial. Based on the results of the underwriting process, the lender will either approve or deny your loan application. If approved, you will receive a loan offer outlining the terms and conditions of the loan. 8. Loan closing. Upon accepting the loan offer, you will proceed to the loan closing stage. During this process, you will sign the necessary paperwork, provide any additional documentation requested by the lender, and finalize the loan agreement. 9. Funding disbursement. After the loan closing is complete, the lender will disburse the loan funds to your business according to the agreed upon terms. Be sure to use the funds responsibly and in accordance with your business plan. 10. Loan repayment. Finally, you will begin repaying the loan according to the repayment schedule outlined in the loan agreement. Make timely payments to maintain a positive relationship with the lender and preserve your business's credit worthiness. By understanding each step of the loan process and being prepared with the necessary documentation and information, entrepreneurs can streamline the process and increase their chances of securing the funding they need to fuel their business growth and success. 2. Assessing your business needs. Before embarking on the journey of obtaining a business loan, it's essential to conduct a thorough assessment of your business's financial requirements. This assessment involves a comprehensive analysis of your current financial situation, future goals, and the specific needs of your business. By taking the time to assess your business needs carefully, you can ensure that you obtain the right type and amount of financing to support your objectives. Start by identifying your financial goals and objectives. Whether you're looking to launch a new product, expand into new markets, purchase equipment, or cover day-to-day operating expenses, it's crucial to have a clear understanding of what you hope to achieve with the loan. Next, determine the amount of capital you require to accomplish your goals. Consider factors such as startup costs, projected expenses, and potential revenue streams. Be realistic in your assessment and ensure that you request enough funding to cover your needs without overextending your business. Once you've determined the amount of capital you need, consider the timing and duration of the loan. Will you need the funds up front? Or will you require ongoing access to a line of credit? How long do you anticipate needing the financing? And what repayment terms are feasible for your business? Additionally, assess your business's ability to repay the loan. Consider factors such as cash flow, revenue projections, and existing debt obligations. A thorough analysis of your business's financial health will help you determine how much debt your business can comfortably take on without jeopardizing its long-term viability. Finally, consider the various types of financing available and choose the option that best aligns with your business needs and objectives. Whether it's a traditional bank loan, a small business administration or SBA loan, a line of credit, or alternative financing options such as crowdfunding or peer-to-peer lending, carefully evaluate the pros and cons of each and select the best option that provides the most favorable terms and conditions for your business. By conducting a comprehensive assessment of your business needs, you can position yourself for success in obtaining and utilizing a business loan effectively. With a clear understanding of your goals, financial requirements, and repayment capacity, you can confidently navigate the loan process and secure the funding needed to propel your business forward. Identifying financial goals. Before seeking a business loan, it's imperative to define your financial goals clearly. These goals serve as the foundation for determining the amount and type of financing needed to support your business objectives. Here's how to identify and articulate your financial goals effectively. Start by envisioning where you want your business to be in the short-term and long-term future. Consider aspects such as revenue targets, market expansion, product development, and operational improvements. Next, prioritize your financial goals based on their importance to your business's overall growth and success. Determine which goals are critical for achieving your vision and which ones can be pursued at a later stage. Quantify your financial goals by attaching specific, measurable targets to each objective. For example, instead of stating a vague goal like increase revenue, specify a target revenue increase percentage or dollar amount. Consider the time frame for achieving each financial goal. Some objectives may be short-term and require immediate attention, while others may be more long-term and strategic in nature. Evaluate the financial resources required to achieve each goal. This includes not only the capital needed to fund initiatives, but also the operational and strategic investments necessary to support growth and expansion. Assess the potential risks and challenges associated with each financial goal. Identify potential obstacles that may hinder your progress and develop contingency plans to mitigate risks effectively. Align your financial goals with your overall business strategy and mission. Ensure that each objective contributes to the overarching vision and values of your business. Communicate your financial goals clearly to key stakeholders, including business partners, investors, lenders, and employees. Transparency and alignment are essential for garnering support and commitment to achieving your objectives. Regularly review and reassess your financial goals to ensure they remain relevant and achievable in light of changing market conditions, industry trends, and internal dynamics. By identifying and articulating your financial goals with clarity and specificity, you can lay the groundwork for securing the right type and amount of financing to support your business's growth and success. With a clear roadmap in place, you can navigate the loan process effectively. Determining loan amounts and terms. When seeking a business loan, determining the appropriate loan amount and terms is crucial for ensuring that the financing meets your business's needs while remaining manageable in terms of repayment. Here's how to approach this process effectively. 1. Assess your funding needs. Start by evaluating your business's financial requirements. Consider factors such as planned expansion, equipment purchases, inventory needs, working capital, and any other expenses you anticipate in the near future. Be thorough in your assessment to ensure you request enough funding to cover all essential costs. 2. Create a detailed budget. Develop a comprehensive budget that outlines your projected expenses and revenue for the period in which you'll be using the loan funds. This budget will serve as a roadmap for determining the loan amount needed to cover any shortfalls and achieve your financial goals. 3. Consider loan repayment capacity. Evaluate your business's ability to repay the loan based on your current cash flow, revenue projections, and existing debt obligations. Calculate your debt service coverage ratio, or DSCR, to determine how much of your revenue is available to cover debt payments. This analysis will help you determine the maximum loan amount your business can afford to repay comfortably. 4. Understand loan terms. Familiarize yourself with the various loan terms available, including interest rates, repayment terms, collateral requirements, and fees. Consider how these terms will impact your overall loan cost and repayment schedule. Choose terms that align with your business's financial situation and objectives. 5. Assess risk tolerance. Evaluate your risk tolerance and financial flexibility when determining loan amounts and terms. Consider factors such as market volatility, economic uncertainty, and potential fluctuations in revenue. Choose loan terms that provide a balance between meeting your funding needs and mitigating risk. 6. Seek professional advice. Consult with financial advisors, accountants, or business mentors to gain insights into the loan process and receive personalized guidance on determining loan amounts and terms. These professionals can offer valuable expertise and help you make informed decisions that align with your business's financial objectives. 7. Negotiate with lenders. Once you've determined your desired loan amount and terms, negotiate with potential lenders to secure the most favorable financing arrangement for your business. Be prepared to provide documentation and justify your funding needs, and don't hesitate to shop around for the best loan offers. By carefully assessing your funding needs, evaluating your repayment capacity, understanding loan terms, and seeking expert advice, you can determine the right loan amount and terms to support your business's growth and success. With a well-designed financing strategy in place, you can access the capital you need to achieve your business objectives while maintaining financial stability and flexibility. 3. Types of business loans. Business loans come in various forms. each tailored to meet different financial needs and circumstances. Understanding the types of business loans available can help you choose the right financing option for your specific situation. Here are some common types of business loans. 1. Term loans. Term loans are traditional loans with fixed repayment terms, typically ranging from 1 to 5 years or more. They are commonly used for long-term investments such as equipment purchases, expansion projects, or business acquisitions. Term loans offer predictable monthly payments and interest rates. 2. Line of credit. A line of credit provides businesses with access to a predetermined credit limit, which they can borrow from as needed. Unlike a term loan, where you receive a lump sum upfront, a line of credit allows you to borrow and repay funds repeatedly, up to the credit limit. This flexibility makes it ideal for managing short-term cash flow fluctuations or covering unexpected expenses. 3. SBA loans. Small Business Administration, or SBA loans, are government-backed loans designed to support small businesses with favorable terms and lower interest rates. SBA loans are available through participating lenders and can be used for various purposes, including working capital, equipment purchases, real estate acquisition, and debt refinancing. 4. Equipment financing. Equipment financing allows businesses to purchase or lease equipment with the equipment itself serving as collateral for the loan. This type of financing is ideal for businesses that need to acquire expensive machinery, vehicles, or technology without depleting their cash reserves. 5. Commercial real estate loans. Commercial real estate loans are used to finance the purchase, construction, or renovation of commercial properties, such as office buildings, retail spaces, or warehouses. These loans typically have longer repayment terms and lower interest rates than other types of business loans. 6. Invoice financing. Invoice financing, also known as accounts receivable financing, allows businesses to borrow against their outstanding invoices to access working capital quickly. This type of financing is particularly useful for businesses with slow-paying customers or seasonal cash flow fluctuations. 7. Merchant cash advance. A merchant cash advance provides businesses with a lump sum of cash in exchange for a percentage of future credit card sales. Repayment is made through daily or weekly deductions from the business's credit card transactions. While merchant cash advances offer fast access to capital, they often come with higher fees and interest rates compared to other financing options. 8. Business credit cards. Business credit cards provide businesses with a revolving line of credit that can be used for various expenses, such as purchasing supplies, covering travel expenses, or managing day-to-day operations. Business credit cards offer convenience and flexibility, but they often come with higher interest rates than other types of financing. Each type of business loan has its advantages and disadvantages, so it's essential to carefully evaluate your business's needs, financial situation, and repayment capacity before choosing the right financing option. Consider factors such as loan amount, interest rates, repayment terms, collateral requirements, and eligibility criteria to make an informed decision that aligns with your business objectives. Traditional bank loans. Traditional bank loans are a common form of business financing, offered by commercial banks and financial institutions. These loans typically have fixed repayment terms, interest rates, and monthly payments. To apply for a traditional bank loan, businesses must undergo a rigorous application process, which includes providing detailed financial information such as balance sheets, income statements, and cash flow projections. Traditional bank loans may be secured or unsecured, depending on the lender's requirements and the borrower's creditworthiness. Secured loans require collateral, such as real estate or equipment, to secure the loan, while unsecured loans do not require collateral but may have higher interest rates. One of the primary advantages of traditional bank loans is their relatively low interest rates compared to other types of financing. Additionally, bank loans often come with longer repayment terms, allowing businesses to spread out their payments over time. However, obtaining a traditional bank loan can be challenging, especially for small businesses or those with less than perfect credit. Banks typically have strict lending criteria and may require extensive documentation and a strong credit history. Despite these challenges, traditional bank loans remain a popular choice for many businesses due to their competitive interest rates, predictable repayment terms, and access to large loan amounts. By carefully preparing their loan applications and demonstrating strong financial stability, businesses can increase their chances of securing a traditional bank loan to support their growth and expansion efforts. SBA loans. Small Business Administration, or SBA loans, are government-backed loans designed to support small businesses by providing access to affordable financing with favorable terms. These loans are facilitated by participating lenders, including banks, credit unions, and other financial institutions, but the SBA guarantees a portion of the loan, reducing the lender's risk and enabling them to offer more attractive terms to borrowers. SBA loans are available for various purposes, including working capital, equipment purchases, real estate acquisition, and debt refinancing. There are several types of SBA loans, each tailored to meet different business needs. 1. SBA 7A loan. The SBA 7A loan program is the agency's primary loan program and offers loans up to $5 million to help small businesses with general financing needs such as starting a new business, expanding operations, or purchasing inventory or equipment. 2. SBA 504 loan. The SBA 504 loan program provides long-term fixed-rate financing for major fixed assets such as real estate or large equipment purchases. These loans are typically used for real estate acquisition, construction, or renovation projects and offer low down payments and favorable terms. 3. SBA microloan. The SBA microloan program provides small loans up to $50,000 to help small businesses and nonprofit organizations with startup costs, working capital, inventory purchases, or equipment financing. These loans are administered through nonprofit intermediary lenders and offer flexible terms and low interest rates. 4. SBA disaster loans. The SBA disaster loan program provides low-interest loans to businesses, homeowners, and renters affected by declared disasters, such as hurricanes, floods, wildfires, or other catastrophic events. These loans can be used to repair or replace damaged property, cover operating expenses, or mitigate economic losses. To qualify for an SBA loan, businesses must meet certain eligibility criteria, including being a for-profit business located in the United States, having a demonstrated need for financing, and meeting sizer standards based on industry and revenue. Additionally, borrowers must have invested equity in the business and exhausted other financing options before applying for an SBA loan. While SBA loans offer numerous benefits, including lower down payments, longer repayment terms, and lower interest rates than conventional loans, they require thorough documentation and a longer approval process. However, for many small businesses, the benefits of SBA loans outweigh the additional paperwork, making them a valuable financing option for achieving their growth and expansion goals. Online lenders. Online lenders have emerged as alternative sources of business financing, offering convenience, speed, and flexibility compared to traditional banks. These lenders operate entirely online, allowing businesses to apply for loans and receive funding quickly and efficiently. One of the primary advantages of online lenders is their streamlined application process. Unlike traditional banks, which may require extensive documentation and take weeks to process loan applications, online lenders typically offer a simple online application that can be completed in minutes. Additionally, online lenders use technology and data analytics to assess creditworthiness and make lending decisions quickly, often providing funding within days or even hours. Online lenders offer a variety of loan products tailored to meet different business needs, including term loans, lines of credit, invoice financing, and merchant cash advances. These loans may have flexible repayment terms, competitive interest rates, and minimal or no collateral requirements, making them accessible to businesses with diverse financial situations and credit profiles. Another advantage of online lenders is their willingness to work with businesses that may not qualify for traditional bank loans due to factors such as limited operating history, lower credit scores, or unconventional business models. By leveraging technology and alternative data sources, online lenders can assess risk more comprehensively and offer financing to a broader range of businesses. However, it's essential for businesses to exercise caution when working with online lenders and carefully review loan terms and conditions. Some online lenders may charge higher interest rates or fees compared to traditional banks, and borrowers should thoroughly understand the total cost of borrowing before accepting a loan offer. Additionally, businesses should research online lenders thoroughly, read customer reviews, and ensure the lender is reputable and trustworthy. Overall, online lenders provide valuable financing options for businesses seeking quick access to capital with minimal hassle. By leveraging technology and innovative lending models, online lenders empower businesses to seize opportunities, overcome challenges, and achieve their growth and expansion goals more efficiently than ever before. Alternative financing options. Alternative financing options refer to non-traditional sources of funding for businesses that offer alternatives to traditional bank loans. These options cater to businesses that may have difficulty assessing financing through conventional channels due to factors such as limited credit history, lack of collateral, or unconventional business models. Here are some common alternative financing options. 1. Peer-to-peer or P2P lending. P2P lending platforms connect borrowers directly with individual investors who fund loans through online marketplaces. These platforms leverage technology to match borrowers with investors based on factors such as creditworthiness, loan purpose, and risk profile. P2P lending offers flexible terms, competitive interest rates, and quick funding compared to traditional bank loans. 2. Crowdfunding. Crowdfunding platforms allow businesses to raise capital by soliciting small contributions from a large number of individuals, typically through online campaigns. Crowdfunding can take various forms, including rewards-based crowdfunding, equity crowdfunding, or debt crowdfunding. This approach enables businesses to access funding while simultaneously building a customer base and generating buzz around their products or services. 3. Venture capital or VC and angel investors. Venture capital firms and angel investors provide equity financing to startups and high-growth businesses in exchange for an ownership stake. These investors typically focus on companies with high growth potential and innovative business models. Venture capital and angel investment can provide significant funding and strategic guidance to fuel business growth, but often require relinquishing some control and ownership in the company. 4. Revenue-based financing. Revenue-based financing, or RBF, providers offer capital to businesses in exchange for a percentage of future revenue. Unlike traditional loans, RBF arrangements do not require fixed monthly payments, but instead involve repaying the financing through a predetermined percentage of monthly revenue. This flexible repayment structure aligns with the business's cash flow and revenue generation. 5. Supplier financing. Supplier financing allows businesses to obtain financing from their suppliers to purchase goods or services. In supplier financing arrangements, suppliers extend credit terms to buyers, allowing them to defer payments for goods or services received. This form of financing can improve cash flow for businesses by providing extended payment terms and preserving working capital. 6. Grants and government programs. Various government agencies, nonprofit organizations, and private foundations offer grants, subsidies, and incentive programs to support small businesses and entrepreneurs. These programs may provide funding for specific purposes, such as research and development, technology adoption, export expansion, or job creation. Unlike loans, grants do not need to be repaid, making them an attractive financing option for eligible businesses. Alternative financing options offer businesses additional avenues to access capital beyond traditional bank loans. By exploring these options, businesses can find financing solutions that align with their unique needs, circumstances, and growth objectives, enabling them to thrive and succeed in today's competitive marketplace. 4. Preparing your business for a loan. Before applying for a business loan, it's essential to ensure that your business is well prepared to increase your chances of approval and secure favorable loan terms. Organizing financial documents. Organizing financial documents is a crucial step in preparing your business for a loan application. Here's how to do it effectively. 1. Compile essential documents. gather all necessary financial documents, including balance sheets, income statements, cash flow statements, tax returns, and bank statements. These documents provide lenders with a comprehensive overview of your business's financial health and performance. 2. Organize documents by category. Sort your financial documents into categories based on their purpose and relevance to the loan application process. Common categories include financial statements, tax documents, business licenses and registrations, legal documents, e.g., articles of incorporation, and any other supporting documentation requested by the lender. 3. Ensure accuracy and completeness. Review each document carefully to ensure accuracy and completeness. Double-check figures, calculations, and supporting information to minimize errors and discrepancies. If necessary, reconcile any inconsistencies or discrepancies before submitting the documents to the lender. 4. Create a document checklist. Develop a checklist of required documents based on the lender's requirements and guidelines. Use this checklist to ensure that you have gathered all necessary documentation and to track your progress throughout the organization process. 5. Maintain digital and physical copies. Keep both digital and physical copies of your financial documents for easy access and reference. Store digital copies securely on your computer or cloud storage platform and maintain hard copies in a designated filing system or binder for quick retrieval when needed. 6. Label and date documents. Clearly label each document with a descriptive title and date to facilitate easy identification and tracking. This ensures that you can quickly locate specific documents and verify their currency during the loan application process. 7. Prepare additional supporting materials. In addition to financial documents, prepare any additional supporting materials requested by the lender, such as business plans, financial projections, collateral documentation, and personal financial statements. These materials provide further insight into your business's operations, growth potential, and ability to repay the loan. 8. Review and update regularly. Regularly review and update your financial documents to ensure they remain accurate, up-to-date, and reflective of your business's current financial position. This ongoing maintenance helps you stay prepared for future loan applications and financial assessments. By organizing your financial documents systematically and thoroughly, you demonstrate professionalism, transparency, and preparedness to potential lenders, increasing your credibility and chances of securing the financing your business needs. Improving creditworthiness. Improving your business creditworthiness is crucial for enhancing your eligibility for loans and securing favorable loan terms. Begin by monitoring your credit reports regularly from major credit bureaus like Dun & Bradstreet, Experian, and Equifax to identify and dispute any inaccuracies promptly. Timely payment of bills and obligations demonstrates reliability and responsibility, so prioritize paying all business expenses, including rent, utilities, suppliers, and lenders, on or before their due dates. Manage debt wisely by avoiding excessive borrowing and maintaining a healthy debt-to-income ratio, making consistent, on-time payments on existing loans, and avoiding maxing out credit lines. Establish positive relationships with suppliers, vendors, and business partners who report payment data to credit bureaus and maintain a mix of different types of credit accounts to demonstrate your ability to manage various types of debt responsibly. Minimize the number of credit inquiries on your business credit report by limiting loan applications and focusing on targeted applications for financing that aligns with your business needs. Cultivate positive relationships with lenders, bankers, and financial institutions by communicating openly, transparently, and professionally. Finally, seek guidance from financial advisors, credit counselors, or business mentors to develop a tailored strategy for improving your business's creditworthiness and navigating the complexities of credit management effectively. Creating a business plan. Creating a comprehensive business plan is essential for articulating your business's vision, goals, and strategies to potential lenders and investors. Start by outlining your business's mission, vision, and core values to provide context for your plan. Then, define your target market, identify your unique value proposition, and conduct a thorough analysis of your industry, competitors, and market trends. Next, outline your business's organizational structure, management team, and key personnel, highlighting their qualifications and roles. Describe your products or services in detail, including their features, benefits, pricing, and positioning in the market. Develop a marketing strategy that outlines how you will reach and attract customers, including your sales channels, promotional tactics, and customer acquisition plan. Create a financial plan that includes a detailed budget, revenue projections, expense forecasts, and a break-even analysis. Finally, outline your business's operational plan, including your production processes, supply chain management, and quality control measures. Define your milestones and metrics for success, and create a timeline for achieving your goals. Throughout the process, be concise, clear, and compelling in your writing, and use visuals such as charts, graphs, and tables to illustrate key points. Review and revise your business plan regularly to reflect changes in your business, industry, or market conditions, and seek feedback from trusted advisors or mentors to ensure its accuracy and effectiveness. 5. Applying for a business loan. Applying for a business loan requires careful preparation and attention to detail to increase your chances of approval and secure favorable loan terms. Finding the right lender. Finding the right lender for your business loan is crucial to securing favorable terms and ensuring a smooth application process. Here's a step-by-step approach to help you locate the ideal lender. Firstly, assess your business's financing needs, including the loan type, amount required, repayment terms, and any specific preferences you have. Next, conduct thorough research to identify potential lenders. Explore a variety of options, including traditional banks, credit unions, online lenders, community development financial institutions or CDFIs, and small business administration or SBA lenders. Evaluate each lender's eligibility criteria to ensure alignment with your business's profile. Consider factors such as credit score, revenue, time in business, industry type, and collateral availability. Compare loan terms offered by different lenders, focusing on interest rates, repayment terms, fees, collateral requirements, and processing times. Choose a lender that offers competitive rates and terms tailored to your needs. Consider specialized lenders that cater to specific industries or financing needs. These lenders may offer tailored loan products, industry expertise, and personalized service. Seek recommendations from other business owners, industry peers, or professional advisors to identify reputable lenders. Personal referrals can provide valuable insights and help you narrow down your options. Research customer feedback and reviews for each lender to gauge their reputation and customer satisfaction levels. Pay attention to both positive and negative feedback to make an informed decision. Schedule consultations with prospective lenders to discuss your financial needs, ask questions, and clarify any concerns you may have. Use these meetings to assess the lender's responsiveness, transparency, and willingness to work with you. By following these steps and conducting thorough due diligence, you can find the right lender that meets your business's financing needs and supports your growth and success. Completing the loan application. Completing the loan application is a pivotal stage in securing financing for your business. Here's a step-by-step guide to help you navigate this process effectively. Start by gathering all required documentation, including financial statements, tax returns, business licenses, legal documents, and any other paperwork specified by the lender. Thoroughly review the lender's application requirements and instructions to ensure you understand what information is needed and how to complete the application accurately. Provide comprehensive information about your business, including its legal structure, industry, address, contact details, and relevant background information. Input your business's financial data, such as revenue, expenses, assets, liabilities, cash flow projections, and existing debt obligations, ensuring accuracy to demonstrate your financial health and repayment capacity. Enter personal information for all business owners, partners, or guarantors involved in the loan application, including names, addresses, social security numbers, and personal financial details. If collateral is required for the loan, provide details about the assets you intend to use as collateral, including value and any existing liens or encumbrances. Attach a copy of your business plan outlining your company's goals, market analysis, marketing strategy, operational plan, and financial projections to strengthen your application and instill confidence in your business's viability. Carefully review the completed loan application for accuracy and completeness before submitting it to the lender. Double-check all information and ensure all required documents are included. Follow up with the lender after submitting the application to confirm receipt and inquire about the status of your application. Be responsive to any requests for additional information and maintain open communication throughout the process. Keep copies of all documents submitted for your records and be proactive in addressing any issues or concerns that arise during the application process. By following these steps and providing thorough, accurate information, you can complete the loan application process efficiently and enhance your chances of securing the financing your business needs. Meeting with lenders. Meeting with lenders is a critical step in the business loan application process, providing an opportunity to discuss your financial needs, present your business plan, and address any questions or concerns the lender may have. Here's how to make the most of these meetings. Start by scheduling appointments with prospective lenders, ensuring all key decision makers from your business can attend. Allow enough time for preparation and make sure the meeting fits everyone's schedules. Prepare an agenda outlining the topics you want to cover, such as introducing your business, discussing financing needs, presenting your business plan, and asking questions. Know your business's financials inside and out, including revenue, expenses, profit margins, cash flow projections, and existing debt obligations. Be ready to discuss these numbers confidently and provide supporting documentation as needed. Present your business plan professionally, highlighting your company's mission, vision, target market, unique value proposition, marketing strategy, operational plan, and financial projections. Tailor your presentation to address the lender's concerns and interests. Anticipate potential questions or objections the lender may raise, such as inquiries about creditworthiness, repayment capacity, industry risks, or market positioning. Be prepared to address these thoughtfully and provide evidence to support your answers. Emphasize your business's strengths, achievements, and competitive advantages to showcase why you are a strong candidate for financing. Highlight factors like industry experience, customer base, growth potential, and track record of success. Maintain transparency and honesty throughout the meeting by providing accurate information about your business and addressing any challenges or risks openly. Building trust with the lender is crucial for establishing a positive relationship. Listen actively to the lender's questions, feedback, and concerns, and respond thoughtfully to demonstrate your understanding and willingness to collaborate. Use the meeting as an opportunity to learn more about the lender's expectations, processes, and loan products. After the meeting, send a thank you email or letter to the lender, expressing appreciation for their time and reiterating your interest in securing financing. Follow up on any action items or requests for additional information promptly to keep the conversation moving forward. By preparing thoroughly, presenting yourself professionally, and engaging in open and constructive dialogue with lenders, you can maximize the effectiveness of your meetings and increase your chances of securing the financing your business needs. 6. Understanding loan terms and conditions. Understanding loan terms and conditions is crucial before committing to any borrowing arrangements. Interest rates and fees. Understanding interest rates and fees is essential when considering a loan. Here's how to grasp these aspects thoroughly. 1. Interest rates. Know whether the interest rate is fixed or variable. A fixed rate remains constant throughout the loan term, while a variable rate may change based on market conditions. Understand the annual percentage rate, or APR, which includes both the interest rate and any fees charged by the lender. 2. Fees. Identify all fees associated with the loan, such as origination fees, application fees, prepayment penalties, and late payment fees. Clarify when these fees are assessed and how they impact the overall cost of borrowing. 3. Loan terms. Familiarize yourself with the loan's terms, including the repayment schedule, loan duration, and any conditions or restrictions imposed by the lender. Ensure you understand your obligations as a borrower and the consequences of defaulting on the loan. 4. Comparative analysis. Compare interest rates and fees from multiple lenders to determine the most cost-effective option for your business. Consider the total cost of borrowing over the loan term rather than just the initial interest rate to make an informed decision. 5. Ask questions. Don't hesitate to ask the lender for clarification on any aspects of the loan terms and fees that you don't understand. Seek transparency and ensure you have a clear understanding of all financial obligations before proceeding with the loan. By understanding interest rates and fees thoroughly, you can make informed decisions and choose the loan option that best meets your business's needs while minimizing the overall cost of borrowing. Repayment terms. Repayment terms outline how you'll repay the loan over time. It's crucial to understand these terms before committing to borrowing. Focus on factors such as the repayment schedule, loan duration, and any flexibility or restrictions on repayment. Clarify whether payments are made monthly, bi-weekly, or quarterly, and ensure you're aware of any penalties for late payments or early repayment. Additionally, understand how the loan term impacts the total cost of borrowing and your business's cash flow. If necessary, negotiate repayment terms that align with your business's financial capabilities and goals to ensure a manageable repayment process. Collateral requirements. Collateral requirements are an important aspect of many business loans. Before agreeing to a loan, it's essential to understand what collateral is required and how it impacts your borrowing arrangements. Collateral is an asset that you pledge to the lender as security for the loan. If you're unable to repay the loan, the lender may seize the collateral to recoup their losses. Take the time to understand the following. 1. Types of collateral. Identify the types of assets that the lender accepts as collateral. This may include real estate, equipment, inventory, vehicles, accounts receivable, or personal assets such as savings or investments. 2. Valuation. Understand how the lender values collateral and determines its eligibility. Some lenders may require professional appraisals to assess the value of real estate or high-value assets. 3. Lien position. Clarify the lender's position in the event of default. If multiple loans are secured by the same collateral, the lender's lien position determines priority in seizing and selling the assets to recover losses. 4. Impact on approval. Recognize the role of collateral in loan approval. Offering collateral can strengthen your loan application by reducing the lender's risk, especially if your business lacks a strong credit history or has limited financial resources. 5. Risk assessment. Assess the risks associated with pledging collateral. Understand the potential consequences of default, including the loss of assets and damage to your business's financial stability and reputation. 6. Alternative options. Explore alternative financing options that don't require collateral if you're uncomfortable with the risk or unable to provide eligible assets. Unsecured loans, lines of credit, or alternative financing products may be available, albeit with different terms and conditions. By understanding collateral requirements thoroughly, you can make informed decisions about borrowing and mitigate risks associated with securing your loan. Be sure to consult with legal and financial advisors to assess the implications of collateral on your business's financial health and long-term sustainability. 7. Managing business loan funds. Managing business loan funds effectively is essential to ensure that the borrowed capital is used efficiently and contributes to the success of your business. Allocating funds wisely. Allocating funds wisely is crucial to making the most of your business loan and ensuring its impact on your company's growth and success. Here's how to allocate funds effectively. 1. Identify priorities. Determine the most pressing needs and opportunities for your business. Whether it's investing in equipment, hiring additional staff, expanding marketing efforts, or improving infrastructure, Prioritize projects or areas that align with your business goals and will yield the highest returns. 2. Allocate based on ROI. Consider the potential return on investment, or ROI, for each allocation. Focus on investments that are likely to generate revenue, increase efficiency, or improve competitiveness in the long run. Prioritize projects with a clear path to profitability and a positive impact on your bottom line. 3. Balance short-term and long-term needs. Strike a balance between addressing immediate needs and investing in long-term growth. While it's important to address pressing issues, allocate a portion of the funds towards initiatives that will drive sustainable growth and build a strong foundation for the future. 4. Diversify investments. Spread out funds across different areas of your business to minimize risk and maximize opportunities. Avoid putting all your eggs in one basket by diversifying investments across marketing, operations, technology, human resources, and other critical areas. 5. Monitor and adjust. Regularly monitor the performance of your investments and adjust allocations as needed. Keep track of key performance indicators, or KPIs, to evaluate the effectiveness of each investment and make informed decisions about reallocating funds to areas with the highest impact. 6. Consider debt repayment. If part of the loan is intended for debt consolidation or refinancing, prioritize paying off high-interest debts first to reduce overall interest costs and improve cash flow. Allocate funds towards debt repayment according to the terms of the loan agreement while ensuring that other business needs are also addressed. Seek professional advice. Consider consulting with financial advisors, accountants, or business consultants to help you develop a strategic allocation plan that aligns with your business objectives and financial situation. Their expertise can provide valuable insights and guidance to make informed decisions about allocating loan funds wisely. By following these guidelines and taking a strategic approach for allocating funds, you can maximize the impact of your business loan and position your company for sustainable growth and success. Tracking expenses. Tracking expenses is essential for maintaining financial health and making informed decisions about your business's finances. Here's how to do it effectively. Establish a system. Set up a reliable system for tracking expenses, whether it's using accounting software, spreadsheets, or a dedicated expense tracking tool. Choose a method that works best for your business's size, complexity, and budget. Categorize expenses. Organize expenses into categories such as payroll, utilities, rent, supplies, marketing, and travel. Create a consistent categorization system to ensure accuracy and consistency in tracking. Record transactions promptly. Record expenses as soon as they occur to maintain an accurate and up-to-date financial record. This helps prevent overspending, identify trends, and track budget allocations effectively. Keep receipts and invoices. Save receipts, invoices, and other supporting documents for all business expenses. Store them electronically or in a designated filing system for easy retrieval during tax preparation or financial audits. Review regularly. Review your expense records regularly to assess spending patterns, identify areas for cost-saving opportunities, and ensure compliance with budgetary goals. Analyze variances between budgeted and actual expenses to make informed adjustments as needed. Monitor cash flow. Track cash flow to ensure that expenses are covered by available funds and to identify any potential cash flow gaps or liquidity issues. Use cash flow forecasting tools to anticipate future expenses and plan accordingly. Stay organized. Keep your expense tracking system organized and up to date to streamline financial management and reporting. Maintain clear records, reconcile accounts regularly, and archive old records according to legal and regulatory requirements. Utilize automation. Leverage automation tools and software integrations to streamline expense tracking processes and minimize manual data entry. Automate recurring payments, expense categorization, and receipt capture to save time and reduce errors. Train staff. Educate employees on expense tracking procedures and policies to ensure consistent adherence to expense reporting guidelines. Provide training on how to submit expenses, use expensive tracking tools, and comply with company expense policies. Seek professional advice. Consider seeking guidance from accounting professionals or financial advisors to optimize your expense tracking processes, implement best practices, and maximize the benefits of accurate financial data. By implementing effective expense tracking practices, you can gain better visibility into your business's financial performance, improve decision-making, and ensure long-term financial stability and success. Building business credit. Building business credit is essential for establishing your company's financial reputation and accessing financing on favorable terms. Here's how to do it effectively. Incorporate your business. Establish your business as a separate legal entity by incorporating or forming a limited liability company, or LLC. This separates your personal and business finances, protecting your personal assets and allowing you to build credit solely in your business's name. Obtain an Employer Identification Number, or EIN. Apply for an EIN from the Internal Revenue Service, or IRS, to identify your business for tax purposes. This unique identifier is necessary for opening business bank accounts and applying for credit. Open a business bank account. Open a dedicated business bank account to manage your company's finances separately from your personal funds. This demonstrates financial responsibility and lays the foundation for building business credit. Establish trade lines. Establish trade relationships with suppliers, vendors, and service providers who report payment history to business credit bureaus. Regularly make on-time payments to these trade accounts to build a positive credit history. Apply for a business credit card. Obtain a business credit card in your company's name and use it responsibly to make purchases and cover expenses. Pay the balance in full and on time each month to demonstrate creditworthiness and avoid accruing interest charges. Monitor your credit report. Regularly review your business credit report from major credit bureaus such as Dun & Bradstreet, Experian, and Equifax. Check for inaccuracies, errors, or fraudulent activity and dispute any discrepancies promptly. Pay bills on time. Timely payment of bills and obligations is crucial for building positive credit history. Pay all business expenses, including rent, utilities, suppliers, and lenders, by their due dates to demonstrate reliability and responsibility. Apply for small loans or lines of credit. Gradually apply for small business loans or lines of credit to establish a track record of borrowing and repayment. Start with smaller amounts and work your way up as your business credit profile strengthens. Maintain a low credit utilization ratio. Keep your credit utilization ratio, the percentage of available credit you're using, low to demonstrate responsible credit management. Aim to use no more than 30% of your available credit at any given time. Build relationships with lenders. Cultivate positive relationships with lenders, bankers, and financial institutions by communicating openly, transparently, and professionally. Establishing rapport with potential lenders can increase your chances of obtaining financing and negotiating favorable loan terms. By following these steps and practicing responsible financial management, you can build a strong business credit profile, improve your company's access to financing, and position your business for long-term success. 8. Repaying your business loan. Repaying your business loan is a crucial step of managing your company's finances responsibly and maintaining a positive relationship with your lender. Developing a repayment plan. Developing a repayment plan for your business loan is essential to ensure timely and consistent payments, maintain financial stability, and preserve your business's credit worthiness. Here's how to create an effective repayment plan. 1. Assess your financial situation. Start by evaluating your business's current financial position, including cash flow, revenue projections, and upcoming expenses. Understand your business's ability to generate income and allocate funds towards loan repayment. 2. Review loan terms. Thoroughly review the terms of your loan agreement, including the repayment schedule, interest rate, and any fees or penalties for early repayment. Understand the total amount owed and the frequency of payments required. 3. Set realistic goals. Determine how quickly you aim to repay the loan based on your financial capabilities and business objectives. Set realistic and achievable repayment goals that align with your cash flow and revenue projections. 4. Prioritize payments. Prioritize loan payments to ensure they are made on time and in full. Allocate funds towards loan repayment as a top financial priority to avoid late fees, penalties, and negative repercussions on your credit score. 5. Create a budget. Develop a detailed budget that outlines all of your business's expenses and revenue sources. Identify areas where you can reduce costs or reallocate funds to free up additional cash flow for loan repayment. 6. Establish a repayment schedule. Create a repayment schedule that outlines when each loan payment is due and the amount to be paid. Consider setting up automatic payments or reminders to ensure payments are made on time and minimize the risk of missed payments. 7. Consider accelerated payments. Explore the possibility of making accelerated or additional payments towards the loan principal to reduce the overall interest cost and pay off the loan sooner. Evaluate your business's financial situation to determine if this is feasible and beneficial. 8. Communicate with your lender. Maintain open communication with your lender throughout the repayment process. If you encounter financial difficulties or anticipate challenges in meeting payment obligations, contact your lender promptly to discuss alternative arrangements or restructuring options. 9. Monitor progress. Regularly monitor your progress towards loan repayment and adjust your repayment plan as needed based on changes in your business's financial situation. Track payments, review your budget regularly, and reassess your goals to stay on track towards achieving repayment milestones. 10. Celebrate milestones. Celebrate milestones and achievements as you make progress towards repaying your business loan. Recognize the dedication and hard work that goes into managing your finances responsibly and achieving your repayment goals. By developing a well-thought-out repayment plan and sticking to it diligently, you can successfully repay your business loan, build a positive credit history, and position your business for long-term financial success. Handling unexpected financial challenges. Handling unexpected financial challenges is a common part of managing a business. Here's how to navigate these situations effectively. Start by assessing the situation thoroughly. Understand the root cause of the challenge and its impact on your business. Gather relevant financial data to gauge the severity and scope of the issue. Next, prioritize your expenses. Ensure that essential costs like payroll, rent, utilities, and inventory are covered first. Look for areas where you can cut discretionary spending to conserve cash flow and ease financial strain. Maintain open communication with stakeholders, including employees, suppliers, lenders, and investors. Keep them informed about the financial challenge, your action plan, and any potential implications. Building trust and transparency can garner support during tough times. Explore strategies to reduce costs and improve efficiency across your business operations. This might involve renegotiating contracts, streamlining processes, or reducing inventory levels. Consider seeking financial assistance to bridge short-term cash flow gaps or address unexpected expenses. Explore options like business loans, lines of credit, grants, or investment from stakeholders. Develop a contingency plan to prepare for future financial challenges. Establish an emergency fund, diversify revenue streams, or secure insurance coverage to buffer against economic downturns or unforeseen events. Review and adjust your business strategy in response to changing market conditions. Explore new markets, diversify products or services, and innovate to generate additional revenue streams and strengthen financial resilience. Seek advice from financial advisors, accountants, or business consultants. They can offer insights, financial analysis, and strategic recommendations tailored to your business's needs and circumstances. Maintain a positive outlook and stay flexible in your approach. Embrace change, learn from setbacks, and view challenges as opportunities for growth and improvement. By taking proactive steps, seeking support when needed, and staying focused on long-term sustainability, you can successfully navigate unexpected financial challenges and emerge stronger as a business leader. Strategies for paying off loans early. Paying off loans ahead of schedule is a smart financial move for businesses. Here are some effective strategies to consider. Make extra payments. Allocate additional funds towards loan payments whenever possible. This reduces the principal balance faster and saves on interest costs. Round up payments. Round up loan payments to the nearest $100 or $1,000. This small adjustment accelerates debt repayment and reduces the overall loan term. Utilize windfalls. Direct unexpected windfalls like bonuses or tax refunds towards loan repayment instead of non-essential expenses. Implement debt repayment methods. Use strategies like the snowball or avalanche method to prioritize debt repayment based on size or interest rate. Refinance at lower rates. Explore refinancing options to secure a lower interest rate, which can decrease monthly payments or shorten the loan term. Consider bi-weekly payments. Switch to bi-weekly payments to make an extra payment each year and speed up debt repayment. Create a repayment plan. Develop a structured plan with specific goals and milestones to track progress and stay motivated. Increase income. Look for opportunities to boost business income through price adjustments, expanding customer base, or diversifying revenue streams. Cut expenses. Review expenses to identify areas for cost reduction, freeing up more funds for loan repayment. Stay committed. Maintain discipline and perseverance in adhering to the repayment plan, even during challenging times. By employing these strategies consistently, businesses can pay off loans early, reduce financial burdens, and achieve greater financial flexibility. 9. Conclusion. In conclusion, effectively managing business loans requires careful planning, disciplined execution, and strategic decision-making. Throughout this guide, we've explored essential aspects such as understanding loan terms, identifying financial goals, preparing for loan application, and developing repayment strategies. By following the insights shared here, businesses can navigate the loan process with confidence, secure financing that aligns with their needs, and leverage it to fuel growth and success. Whether it's establishing a strong credit profile, optimizing loan terms, or paying off debt ahead of schedule, proactive financial management is key to achieving long-term sustainability and resilience in today's dynamic business environment. Remember, each business is unique, and there's no one-size-fits-all approach to managing loans. It's essential to assess your business's specific circumstances, goals, and risk tolerance when making financial decisions. With careful planning, prudent decision-making, and a commitment to financial health, businesses can thrive and prosper in the face of challenges and opportunities alike. You have been listening to Business Loans: Getting and Using a Loan for a Small Business. Written by Daniel Shore. Narrated by Jacob Simmons. Bankruptcy: Laws and Profits Related to Bankruptcies. Written by Daniel Shore. Narrated by Jacob Simmons. 1. Introduction to Bankruptcy. Bankruptcy is a complex legal process governed by specific laws that vary from country to country. It typically involves a debtor petitioning a court to declare them unable to meet their financial obligations. This declaration triggers an automatic stay, halting most collection activities by creditors. The purpose of bankruptcy is twofold: to provide debtors with a fresh start by discharging some or all of their debts, and to ensure fair treatment of creditors by distributing available assets equitably. Bankruptcy proceedings can involve liquidating assets to repay creditors. Bankruptcy can have long-lasting financial and personal consequences, impacting credit scores, future borrowing ability, and even employment prospects. However, it can also offer relief from overwhelming debt burdens and a path toward financial stability for those facing insurmountable financial challenges. It's crucial for individuals and businesses considering bankruptcy to seek legal advice to understand their options and navigate the process effectively. 2. Historical overview of bankruptcy laws. Bankruptcy laws have evolved over centuries to address changing economic and social conditions. The concept of bankruptcy dates back to ancient civilizations such as Mesopotamia and Rome, where debt relief measures were implemented to prevent debtor enslavement or imprisonment. In the Middle Ages, European monarchs issued charters granting bankruptcy protection to debtors, often as a means to promote trade and economic growth. However, these early laws were often ad hoc and lacked uniformity. During the 18th and 19th century, modern bankruptcy laws began to emerge, particularly in England and the United States. In England, the Bankruptcy Act of 1705 established a framework for debtor relief, while the United States adopted bankruptcy provisions in its Constitution in 1789, empowering Congress to enact, quote, uniform laws on the subject of bankruptcies throughout the United States, close quote. In the U.S., bankruptcy laws have undergone significant revisions over time. The Bankruptcy Act of 1898 established the basic structure of bankruptcy law, allowing both voluntary and involuntary bankruptcy filings by individuals and businesses. This law remained largely unchanged until the mid-20th century. In 1978, the United States enacted the Bankruptcy Reform Act, which replaced the antiquated bankruptcy system with a more comprehensive framework. It introduced Chapter 7, or liquidation, and Chapter 13, or reorganization bankruptcy for individuals, and Chapter 11, or reorganization bankruptcy for businesses. Subsequent amendments and reforms, such as the Bankruptcy Abuse Prevention and Consumer Protection Act of 2005, aimed to address perceived abuses and improve the bankruptcy process. Internationally, bankruptcy laws vary widely, reflecting cultural, economic, and legal differences. However, many countries have adopted similar bankruptcy principles, such as providing a fresh start for debtors while ensuring fair treatment for creditors. Overall, the historical evolution of bankruptcy laws reflects society's recognition of the need to balance the interests of debtors and creditors and to provide mechanisms for resolving financial distress in a fair and orderly manner. 3. Types of bankruptcy. Bankruptcy law typically distinguishes between several types of bankruptcy, each designed to address different financial situations for individuals and businesses. Chapter 7 bankruptcy, often referred to as liquidation bankruptcy, involves the sale of a debtor's non-exempt assets to repay creditors. Any remaining eligible debts are discharged, providing the debtor with a fresh start. Chapter 13 bankruptcy, known as reorganization bankruptcy, for individuals, allows debtors to create a repayment plan to settle their debts over 3 to 5 years. Debtors can retain their assets while making regular payments to creditors. Chapter 11 bankruptcy primarily applies to businesses and allows for the reorganization of debts while the business continues operations. It enables businesses to renegotiate contracts, restructure debt, and potentially emerge as a viable entity. Chapter 12 bankruptcy is specifically tailored for family farmers and fishermen, providing them with a reorganization plan to repay debts while keeping their operations running. There are also bankruptcy options for municipalities, such as Chapter 9 bankruptcy, which allows financially distressed cities, towns, and other government entities to restructure their debts under court supervision. The choice of bankruptcy chapter depends on various factors, including the debtor's financial situation, type of debts, and long-term goals. Consulting with a qualified bankruptcy attorney is crucial for determining the most appropriate course of action. 3.1. Chapter 7 Bankruptcy. Chapter 7 bankruptcy, commonly known as liquidation bankruptcy, involves the sale of a debtor's non-exempt assets by a court-appointed trustee to repay creditors. Once the assets are liquidated, eligible debts are discharged, meaning the debtor is no longer legally obligated to repay them. Individuals and businesses can file for Chapter 7 bankruptcy, but eligibility criteria vary. Notably, individuals must pass a means test to qualify, which assesses their income relative to the median income in their state and their ability to repay debts. Chapter 7 bankruptcy involves a fresh start for debtors by eliminating most unsecured debts, such as a credit card debt, medical bills, and personal loans. However, certain debts, such as taxes, student loans, and child support, are generally not dischargeable. Filing for Chapter 7 bankruptcy triggers an automatic stay, halting most collection actions by creditors, including wage garnishment and foreclosure proceedings. It also provides relief from harassing creditor calls and allows debtors to regain control of their finances. While Chapter 7 bankruptcy offers significant debt relief, it also has consequences, such as potential loss of assets, damage to credit scores, and limited eligibility for future credit. It's essential for individuals considering Chapter 7 bankruptcy to weigh the benefits and drawbacks carefully and seek legal advice to navigate the process effectively. 3.2. Chapter 11 Bankruptcy. Chapter 11 bankruptcy, often referred to as reorganization bankruptcy, is primarily designed for businesses but could also be used by individuals with significant debts or complex financial situations. Unlike Chapter 7 bankruptcy, which involves liquidation of assets, Chapter 11 allows businesses to restructure their debts and operations to continue operating while repaying creditors. In a Chapter 11 bankruptcy, the debtor remains in control of their business operations as a, quote, debtor in possession, close quote, while developing a reorganization plan. This plan outlines how the business will restructure its debts, renegotiate contracts, and potentially sell assets to repay creditors over time. Creditors have the opportunity to vote on the reorganization plan, and if approved by the court, it becomes binding on all parties involved. Chapter 11 bankruptcy provides businesses with an opportunity to address financial challenges, reduce debt burdens, and emerge as a viable entity. While Chapter 11 bankruptcy offers flexibility and the potential for businesses to survive financial distress, it can be a complex and expensive process. It requires careful planning, negotiation with creditors, and compliance with court procedures. Additionally, it may involve oversight by a bankruptcy trustee appointed by the court to monitor the debtor's actions. Overall, Chapter 11 bankruptcy provides a mechanism for businesses to restructure their debts and operations, potentially saving jobs and preserving value for stakeholders. However, it's a complex process that requires careful consideration and legal guidance to navigate effectively. 3.3. Chapter 13 Bankruptcy. Chapter 13 bankruptcy, also known as reorganization bankruptcy for individuals, offers a structured repayment plan to help debtors manage their debts over a period of 3 to 5 years. It's designed for individuals with regular income who have the ability to repay a portion of their debts but need assistance in restructuring their payments. In a Chapter 13 bankruptcy, the debtor proposes a repayment plan to the court, outlining how they will repay creditors over the designated period. The plan typically prioritizes certain debts, such as mortgage arrears or car loans, while consolidating other debts into manageable payments. Unlike Chapter 7 bankruptcy, which involves liquidating assets, Chapter 13 allows debtors to retain their assets while repaying creditors. This can include homes, vehicles, and other valuable property. Once the court approves the repayment plan, the debtor makes regular payments to a trustee, who then distributes the funds to creditors according to the terms of the plan. At the end of the repayment period, any remaining eligible debts are discharged, providing the debtor with a fresh start. Chapter 13 bankruptcy offers several benefits, including the ability to stop foreclosure proceedings, catch up on missed mortgage or car payments, and protect co-signers from creditor actions. It also provides relief from harassing creditor calls and allows debtors to regain control of their finances. However, Chapter 13 bankruptcy also has limitations and requirements, such as meeting income and debt limits, adhering to the repayment plan, and obtaining court approval for major financial decisions. It's crucial for individuals considering Chapter 13 bankruptcy to consult with a qualified attorney to understand their options and navigate the process effectively. 4. Tax-free strategies for business owners. As a business owner, you want to save on taxes where you can. In this chapter, we will discuss some common methods. Incorporation benefits. Incorporation offers several benefits to businesses, including 1. Limited liability. One of the primary benefits of incorporation is limited liability protection. In a corporation, shareholders' personal assets are typically protected from the debts and liabilities of the business. This means that if the business is sued or goes bankrupt, the shareholders generally cannot be held personally liable beyond their investment in the company. 2. Perpetual existence. Corporations have perpetual existence, meaning they can continue to operate indefinitely even if the ownership or management changes. This provides stability and continuity for the business, making it easier to attract investors, secure financing, and plan for long-term growth. 3. Access to capital. Corporations have various avenues for raising capital, including issuing stocks and bonds, securing loans, and attracting investment from venture capitalists or angel investors. The ability to raise capital can help businesses finance expansion, research and development, and other strategic initiatives. 4. Tax benefits. While taxation can be more complex for corporations, they may benefit from certain tax advantages, such as deductible business expenses, retirement plans, and healthcare benefits. Additionally, some corporate structures, such as S corporations, allow for pass-through taxation, where profits are taxed at the individual shareholder level rather than at the corporate level. 5. Credibility and prestige. Incorporating can enhance a business' credibility and reputation, as it signals professionalism, stability, and commitment to long-term success. This can be especially important when dealing with customers, suppliers, investors, and other stakeholders. 6. Employee benefits. Corporations can offer employee benefits such as health insurance, retirement plans, stock options, and other incentives to attract and retain top talent. These benefits can help businesses compete for skilled employees and foster a positive work environment. Summarized, incorporation offers several advantages that can help businesses protect their owners, attract investment, access capital, and achieve long-term success. However, the decision to incorporate should be based on careful consideration of the business goals, structure, and legal and financial implications. Consulting with legal and financial professionals is advisable when considering incorporation. Depreciation and expense deductions. Depreciation and expense deductions are both important concepts in tax accounting that allow businesses to reduce their taxable income and lower their tax liabilities. Here's how they work. 1. Depreciation. Depreciation is the process of allocating the cost of a tangible asset over its useful life. Tangible assets such as buildings, machinery, equipment, vehicles, and furniture lose value over time due to wear and tear, obsolescence, or other factors. Instead of deducting the full cost of these assets in the year of purchase, businesses spread the cost over several years through depreciation deductions. Depreciation deductions allows businesses to match the expense of using the asset with the revenue it generates over its useful life. There are several methods for calculating depreciation, including straight-line depreciation, accelerated depreciation, such as ACRS, and units of production depreciation. The method chosen depends on factors such as the asset's useful life, expected usage, and tax regulations. 2. Expense deductions. Expense deductions, also known as operating expenses or business expenses, are costs incurred in the ordinary course of business operations that are deductible for tax purposes in the year they are paid or incurred. These expenses may include items such as rent, utilities, wages, salaries, advertising, supplies, insurance, travel, and professional fees. Unlike depreciation, which applies to the cost of acquiring tangible assets, expense deductions apply to ongoing operational costs necessary to run the business. By deducting these expenses from their taxable income, businesses can reduce their tax liabilities and improve their bottom line. Both depreciation and expense deductions are essential tools for businesses to manage their tax obligations effectively while accurately reflecting their financial performance. However, it's crucial for businesses to comply with tax laws and regulations governing depreciation methods, deduction eligibility, record-keeping requirements, and reporting obligations to avoid penalties and scrutiny from tax authorities. Consulting with tax professionals or accountants can help businesses navigate these complexities and optimize their tax strategies. Retirement plans for business owners. Business owners have several retirement plan options available to them to help save for their golden years. Some of the most common retirement plans for business owners include 1. 401k plans. A 401k plan is a tax-deferred retirement savings plan sponsored by an employer. Business owners can set up a 401k plan for themselves and their employees, allowing participants to contribute a portion of their salary to the plan on a pre-tax basis. Employers may also choose to match employee contributions up to a certain percentage. Contributions and investment earnings grow tax-deferred until withdrawn in retirement. 2. SEP IRA. Simplified Employee Pension Individual Retirement Account. A SEP IRA is a retirement plan specifically designed for self-employed individuals and small business owners. Business owners can contribute their own SEP IRA and make deductible contributions on behalf of eligible employees. Contributions are made on a pre-tax basis, and investment earnings grow tax-deferred until withdrawn in retirement. 3. Simple IRA. Savings Incentive Match Plan for Employees' Individual Retirement Account. A simple or ISMPLE IRA is a retirement plan available to small businesses with 100 or fewer employees. Business owners can establish a simple IRA plan for themselves and their employees, allowing participants to make salary deferral contributions on a pre-tax basis. Employers are required to either match employee contributions up to a certain percentage or make non-elective contributions on behalf of eligible employees. 4. Solo 401k or individual 401k. A solo 401k plan is designed for self-employed individuals with no employees other than a spouse. Business owners can contribute to their own solo 401k plan as both an employer and an employee, allowing for potentially higher contribution limits than other retirement plans. Contributions can be made on a pre-tax or after-tax basis, depending on the plan design. 5. Defined benefit plans. Defined benefit plans, also known as pension plans, promise a specified monthly benefit to participants in retirement. Business owners can set up a defined benefit plan to provide themselves with a predictable retirement income stream. Contributions to defined benefit plans are typically determined by an actuary based on factors such as age, salary, and desired retirement income. Each type of retirement plan has its own contribution limits, eligibility requirements, and administrative responsibilities. So, it's essential for business owners to carefully evaluate their options and consult with a financial advisor or tax professional to determine the best retirement plan for their specific needs and circumstances. 5. Bankruptcy laws and regulations. Bankruptcy laws and regulations govern the process of filing for bankruptcy, including eligibility criteria, procedures, and protections for debtors and creditors. These laws are primarily enacted at the national level but may vary by jurisdiction. 5.1. Federal Bankruptcy Code. The Federal Bankruptcy Code, officially known as Title 11 of the United States Code, is the primary body of federal bankruptcy law in the United States. Enacted by Congress, it governs all bankruptcy cases filed in the country's bankruptcy courts. Key features of the Federal Bankruptcy Code include: 1. Types of bankruptcy. The code outlines different chapters of bankruptcy, including Chapter 7 or liquidation, Chapter 11 or reorganization, Chapter 13, individual reorganization, and Chapter 12, family farmer or fisherman or reorganization. 2. Eligibility criteria. It establishes eligibility requirements for filing bankruptcy under each chapter, such as income limits for Chapter 7 and debt limits for Chapter 13. 3. Automatic stay. The code provides for an automatic stay upon filing bankruptcy, which halts most collection actions by creditors, including lawsuits, foreclosures, and wage garnishments. 4. Debtor and creditor rights. It outlines the rights and obligations of debtors and creditors throughout the bankruptcy process, including the distribution of assets, discharge of debts, and reorganization plans. 5. Trustee appointment. The code governs the appointment and responsibilities of bankruptcy trustees, who oversee bankruptcy cases, administer assets, and ensure compliance with bankruptcy laws. 6. Reorganization plans. It sets forth the requirement for developing and confirming reorganization plans under Chapter 11, 12, and 13, including creditor voting procedures and court approval. 7. Bankruptcy discharge. The code specifies the conditions under which debts may be discharged in bankruptcy, as well as exceptions to discharge, such as certain tax debts and student loans. 8. Fraudulent transfers. It addresses fraudulent transfers and preferences which involve the transfer of assets or payments made by a debtor to preferential creditors before filing bankruptcy. The Federal Bankruptcy Code is supplemented by bankruptcy rules, local court procedures, and case law interpretations. It provides a comprehensive framework for addressing financial distress and facilitating the orderly resolution of debts for individuals and businesses throughout the United States. 5.2. State bankruptcy laws. State bankruptcy laws supplement federal bankruptcy laws and may vary significantly from state to state. While federal law governs most aspects of bankruptcy, including eligibility criteria, procedures, and protections for debtors and creditors, state laws can influence certain aspects of the bankruptcy process, such as exemptions and property rights. For example, states have the authority to set their own exemptions, which determine the types and amounts of property that debtors can protect from creditors during bankruptcy proceedings. Some states allow debtors to choose between state and federal bankruptcy exemptions, while others require the use of state-specific exemptions. Additionally, state laws may affect property rights, marital property considerations, and other aspects of bankruptcy cases. For instance, community property states recognize marital property jointly owned by spouses, which can impact bankruptcy proceedings involving couples. While federal bankruptcy laws provide a uniform framework for bankruptcy cases nationwide, state laws play a crucial role in shaping the bankruptcy process and determining the rights and obligations of debtors and creditors within each state's jurisdiction. As a result, individuals considering bankruptcy should consult with a qualified attorney familiar with both federal and state bankruptcy laws to understand their rights and options fully. 6. Impact of bankruptcy on individuals and businesses. Bankruptcy can have significant implications for both individuals and businesses. For individuals, filing for bankruptcy can provide relief from overwhelming debt burdens and harassment by creditors. It may allow individuals to retain certain assets while eliminating or restructuring debts, providing a fresh start financially. However, bankruptcy can also have negative consequences, including damage to credit scores, difficulty obtaining future credit, and potential loss of assets. For businesses, bankruptcy can offer an opportunity to restructure debts, renegotiate contracts, and potentially continue operations while addressing financial challenges. Chapter 11 bankruptcy, in particular, allows businesses to reorganize and emerge as viable entities. However, bankruptcy can also result in the closure of businesses, loss of jobs, and damage to reputation and relationships with creditors and suppliers. Overall, the impact of bankruptcy depends on various factors, including the type of bankruptcy filed, the debtor's financial situation, and the specific circumstances surrounding the case. While bankruptcy can offer relief and a path toward financial recovery, it's essential for individuals and businesses to carefully consider the consequences and seek professional guidance to navigate the process effectively. 8. Bankruptcy and profits. Bankruptcy can impact profits differently for individuals and businesses. For individuals, bankruptcy can provide relief from overwhelming debt burdens, potentially freeing up income that was previously allocated to debt payments. This can lead to increased disposable income. 8.1. Opportunities in distressed assets. Distressed assets, such as properties, businesses, or financial instruments, present various opportunities for investors and entrepreneurs. These opportunities arise from the financial challenges faced by the owners or holders of these assets, which can result in undervaluation or the need for restructuring. Here are several ways individuals and businesses can capitalize on distressed assets. 1. Asset acquisition. Purchasing distressed real estate, businesses, or financial instruments at a discounted price can be an attractive investment opportunity. Investors can acquire assets below their intrinsic value, potentially yielding significant returns once the assets are stabilized or repositioned. 2. Restructuring and turnaround management. Distressed businesses often require restructuring to improve operational efficiency, reduce costs, and enhance profitability. Entrepreneurs with expertise in turnaround management can acquire struggling companies, implement strategic changes, and revitalize them to generate sustainable profits. 3. Debt or equity investment. Providing capital to distressed companies in exchange for debt or equity stakes can be an effective way to support their turnaround efforts. Investors may negotiate favorable terms, such as preferred stock or senior debt, to mitigate risks and maximize potential returns. 4. Loan purchasing and debt trading. Purchasing distressed debt from creditors or financial institutions allows investors to acquire debt instruments at a discount and potentially negotiate favorable terms with borrowers. Debt trading platforms provide opportunities to buy and sell distressed debt, facilitating liquidity in the secondary market. 5. Real estate investment. Distressed real estate assets, such as foreclosed properties or properties in foreclosure, can be acquired for renovation, redevelopment, or resale. Real estate investors can capitalize on market inefficiencies and distressed sellers to acquire properties at below market prices. 6. Bankruptcy asset sales. Bankruptcy proceedings often involve the sale of assets to repay creditors. Investors can participate in bankruptcy auctions or asset sales to acquire distressed assets at competitive prices, leveraging their expertise to identify value and opportunities for repositioning. 7. Distressed securities investing. Investing in distressed securities, such as bonds or equities of financially troubled companies, can offer high-risk, high-reward opportunities. Distressed debt investors may participate in debt-to-equity conversions or debt restructurings to capitalize on potential upside. Overall, opportunities in distressed assets require careful evaluation, due diligence, and strategic execution to mitigate risks and maximize returns. Investors and entrepreneurs with the necessary expertise, resources, and risk tolerance can capitalize on market inefficiencies and create value through astute management and investment strategies. 8.2. Bankruptcy investing strategies. Bankruptcy investing involves capitalizing on opportunities presented by distressed companies or assets undergoing bankruptcy proceedings. Here are several strategies investors employ. 1. Equity investing. Purchasing shares of distressed companies' stock at low prices can lead to significant returns if the company successfully restructures and emerges from bankruptcy. However, this strategy carries high risk, as many distressed companies ultimately file for Chapter 7 liquidation, resulting in equity holders receiving little to no value. 2. Debt investing. Investing in distressed debt, such as bonds or loans issued by companies undergoing bankruptcy, allows investors to potentially acquire claims on assets or receive higher payouts in the event of a successful restructuring. Distressed debt investors may purchase debt instruments at a discount and participate in bankruptcy proceedings to negotiate favorable terms or convert debt to equity. 3. Credit default swaps, or CDS. CDS contracts allow investors to hedge against the default risk of distressed companies' debt or speculate on their creditworthiness. Investors can buy CDS contracts to protect against losses on their existing investments or profit from the deterioration of a company's credit profile. 4. Bankruptcy claims trading. Trading bankruptcy claims involves buying and selling the right to receive distributions from a bankrupt company's estate. Investors may acquire claims from creditors or other stakeholders at a discount and participate in bankruptcy proceedings to receive payouts or negotiate settlements. 5. Asset acquisition. Acquiring distressed assets such as real estate, intellectual property, or inventory from bankrupt companies can provide opportunities for investors to capitalize on undervalued assets or asset sales. Investors may purchase assets directly from bankruptcy auctions or negotiate deals with bankruptcy trustees or administrators. 6. Turnaround investing. Investing in distressed companies with the potential for successful turnaround and reorganization can yield substantial returns if the company's operations are revitalized and profitability improves. Turnaround investors often provide capital, strategic guidance, or operational expertise to support the company's restructuring efforts. 7. Distressed securities funds. Investing in specialized funds or vehicles focused on distressed securities allows investors to gain exposure to a diversified portfolio of distressed assets managed by experienced professionals. Distressed securities funds may employ various strategies, including equity, debt, and hybrid approaches, to capitalize on opportunities in distressed markets. Overall, bankruptcy investing requires thorough research, due diligence, and a deep understanding of bankruptcy laws and procedures. Investors should carefully assess the risks and potential rewards of each investment strategy and consider consulting with experienced professionals such as bankruptcy attorneys or financial advisors before making investment decisions in this complex and volatile market. 8.3. Bankruptcy auctions and sales. Bankruptcy auctions and sales are common features of bankruptcy proceedings, allowing trustees or administrators to liquidate assets and distribute proceedings to creditors. These auctions provide opportunities for investors and buyers to acquire assets at competitive prices, often below market value. Bankruptcy auctions may include various types of assets, such as real estate, equipment, inventory, intellectual property, and other tangible or intangible assets. These assets are typically sold to the highest bidder, either through live auctions, online auctions, or sealed bids, depending on the preference of the bankruptcy court and the trustee overseeing the case. Participating in bankruptcy auctions can offer several advantages for buyers, including the opportunity to acquire assets at discounted prices, access to a wide range of properties or assets, and the ability to purchase assets free and clear of liens or encumbrances. However, buyers should conduct thorough due diligence before participating in bankruptcy auctions to assess the condition, value, and legal status of the assets being sold. Additionally, buyers should be prepared to act quickly and decisively during the auction process, as competition from the other bidders can be intense. For trustees and administrators, bankruptcy auctions and sales serve as a means to maximize the value of the debtor's estate and facilitate the orderly distribution of proceeds to creditors. These sales help expedite the resolution of bankruptcy cases and provide transparency and fairness in asset disposition. Overall, bankruptcy auctions and sales play a critical role in the bankruptcy process, providing opportunities for buyers to acquire assets at discounted prices and enabling trustees to efficiently liquidate assets and distribute proceeds to creditors. 9. Conclusion. In conclusion, bankruptcy is a complex legal process that impacts individuals, businesses, and creditors in various ways. Whether seeking relief from overwhelming debts, restructuring operations, or asserting creditor rights, bankruptcy involves navigating intricate legal frameworks and financial considerations. For individuals, bankruptcy can offer a fresh start by eliminating or restructuring debts, but it also carries consequences, such as damage to credit scores and potential loss of assets. Businesses facing financial distress may find opportunities for reorganization and turnaround, but bankruptcy can also result in closure and job losses. Creditors, meanwhile, must navigate bankruptcy proceedings to protect their interests and maximize recovery, whether through debt repayment, asset liquidation, or negotiations with debtors. Throughout the bankruptcy process, careful consideration, strategic planning, and professional guidance are essential for all parties involved. Understanding the implications of bankruptcy laws and regulations, evaluating investment opportunities, and navigating court proceedings are crucial steps toward achieving the best possible outcomes in a challenging financial landscape. You have been listening to Bankruptcy, Laws and Profits Related to Bankruptcies. Written by Daniel Shore. Narrated by Jacob Simmons. Debt. How to quickly get out of debt. Written by Daniel Shore. Narrated by Jacob Simmons. 1. Introduction. Debt can be handy when you need the upfront cash, but it is awful when you try to get out of it. In this book, we'll explore practical strategies and techniques to help you break free from the burdens of debt and regain control of your financial life. Whether you're dealing with credit card debt, student loans, or other financial obligations, this guide will provide you with the tools and knowledge to accelerate your journey toward financial freedom. By understanding the psychology of debt, mastering budgeting skills, and implementing effective debt repayment strategies, you can pave the way to a brighter financial future. Let's embark on this transformative journey together and take the first steps towards a debt-free life. 2. Understanding debt. Debt comes in various forms, such as loans, bonds, mortgages, and credit card balances. Each type of debt has its own terms and conditions, including interest rates, repayment schedules, and collateral requirements. Managing debt effectively involves understanding these terms, budgeting to make timely payments, and avoiding accumulating more debt than you can comfortably repay. Failure to manage debt responsibly can lead to financial strain, damaged credit scores, and even bankruptcy. On the other hand, using debt wisely can help individuals and businesses achieve their goals by providing access to funds for investments, education, or essential purchases. Debt is an important financial concept that individuals, businesses, and governments deal with regularly. Here's an overview of understanding debt. 1. Definition. Debt is money or assets owed by one party, the debtor, to another party, the creditor. It is a liability that represents a future obligation to repay the borrowed amount, usually with interest. 2. Types of debt. Consumer debt. This includes credit card debt, personal loans, student loans, and other debts incurred by individuals for personal or household purposes. Business debt. Companies often take on debt to finance operations, expand, or make investments. Government debt. Governments issue bonds and take on debt to finance public spending, infrastructure projects, and other obligations. 3. Reasons for debt. Financing major purchases. Debt allows individuals and businesses to acquire assets, e.g., houses, cars, equipment, that they may not be able to afford upfront. Bridging cash flow gaps. Debt can help cover temporary shortfalls in income or cash flow. Leveraging investments. Businesses may use debt to finance investments or projects with the expectation of generating higher returns. Government spending. Governments may borrow to fund public services, infrastructure, and economic stimulus programs. 4. Interest and repayment. Interest is the cost of borrowing money and is typically expressed as an annual percentage rate, or APR. Repayment terms vary depending on the type of debt and the agreement with the lender. They may involve fixed monthly payments or lump sum payments. 5. Credit scores and debt management. Credit scores assess an individual's creditworthiness based on their debt levels, payment history, and other factors. Responsible debt management involves budgeting, making timely payments, and avoiding excessive debt accumulation. 6. Debt consolidation and refinancing. Debt consolidation combines multiple debts into a single loan, often with a lower interest rate, to simplify repayment. Refinancing involves replacing an existing debt with a new loan, typically with better terms or a lower interest rate. 7. Bankruptcy and debt relief. In cases of severe financial distress, individuals or businesses may file for bankruptcy, which can provide debt relief or a structured repayment plan. Debt relief programs or debt settlement options may also be available for those struggling with overwhelming debt. Understanding debt, its purposes, and the associated risks and responsibilities is crucial for effective financial management and decision-making. It's important to borrow responsibly, maintain a good credit score, and have a plan for repayment to avoid financial difficulties. 3. Assessing your debt. Assessing your debt involves taking stock of all the money you owe, including credit card balances, loans, mortgages, and any other liabilities. It's essential to gather information about each debt, such as the outstanding balance, interest rate, minimum monthly payment, and repayment term. Once you have a clear picture of your debt, you can prioritize repayment by focusing on high-interest debt first or using strategies like the debt snowball or debt avalanche methods. It's also important to evaluate your budget to see how much you can afford to allocate towards debt repayment each month while still covering your other expenses. Regularly monitoring your debt situation and making adjustments as needed can help you stay on track towards becoming debt-free and achieving your financial goals. 4. Creating a budget. Creating a budget involves outlining your income and expenses to effectively manage your finances. Start by listing all sources of income, such as salaries, freelance earnings, or investment returns. Then list your expenses, including fixed costs like rent or mortgage, utilities, and insurance, as well as variable expenses like groceries, dining out, and entertainment. Next, compare your total income to your total expenses. If your expenses exceed your income, look for areas where you can cut back or reduce spending. Allocate a portion of your income towards savings, emergency funds, and debt repayment. Regularly review and adjust your budget as needed to accommodate changes in income or expenses. Budgeting tools and apps can help streamline the process and track your progress towards financial goals. The key is to find a budgeting approach that works for you and helps you achieve financial stability and security. Creating a budget is an essential step for managing your finances effectively. Here's a step-by-step guide to help you create a comprehensive budget. 1. Determine your income. List all sources of income. Include your salary, bonuses, freelance work, investment income, and any other sources of regular income. Calculate your total monthly income. Make sure you're considering net income after taxes. 2. Track your expenses. Fixed expenses. These are regular, recurring expenses such as rent or mortgage, utilities, insurance, loan payments, and subscriptions. Variable expenses. These could vary each month and include groceries, dining out, entertainment, transportation, and clothing. Periodic expenses. These are not monthly but occur regularly, like car maintenance, medical bills, or annual subscriptions. 3. Categorize your spending. Essential expenses. These are necessities such as housing, food, utilities, and transportation. Non-essential expenses. These include dining out, entertainment, hobbies, and other discretionary spending. 4. Set financial goals. Short-term goals. These could include saving for a vacation, a new gadget, or an emergency fund. Long-term goals. These might include saving for retirement, buying a house, or paying off debt. 5. Create the budget. Allocate income to each category. Start with your essential expenses, then allocate funds to non-essential expenses and savings goals. Use budgeting tools. You can use spreadsheets like Excel or Google Sheets, budgeting apps like Mint, YNAB, or Pocket Guard, or even a simple pen and paper method. 6. Monitor and adjust. Track your spending. Regularly compare your actual spending to your budgeted amounts. Use apps or bank alerts to help track expenses. Adjust as necessary. If you find you're overspending in one category, adjust your budget or reduce spending in other areas. 7. Review periodically. Monthly review. Go over your budget at the end of each month to see where you did well and where you need to improve. Annual review. Review your budget annually to adjust for any changes in income, expenses, or financial goals. Tips for success. Be realistic. Set achievable goals and realistic budget limits. Automate savings. Set up automatic transfers to your savings accounts. Stay disciplined. Avoid impulse purchases and stick to your budget. Use envelopes. For cash spending, use the envelope system to manage variable expenses. By following these steps and regularly reviewing your progress, you can create a budget that helps you manage your money effectively and achieve your financial goals. 5. Strategies for paying off debt. There are several strategies for paying off debt, depending on your financial situation and preferences. 5.1. Snowball Method. The snowball method is a debt repayment strategy where you start by paying off your smallest debt first, regardless of interest rates, while making minimum payments on your other debts. Once the smallest debt is paid off, you roll the money you were putting towards that debt into paying off the next smallest debt. This method focuses on building momentum and motivation by quickly eliminating smaller debts, leading to a sense of achievement and progress. As you continue to snowball payments, you tackle larger debts until you're debt-free. It's effective for those who need psychological wins to stay motivated, even if it might not save as much on interest compared to the debt avalanche method. 5.2. Avalanche Method. The avalanche method is a debt repayment strategy where you prioritize paying off debts with the highest interest rates first, while making minimum payments on your other debts. Once the debt with the highest interest rate is paid off, you redirect the money you are putting towards that debt to the next highest interest rate debt, and so on. This method is focused on minimizing the amount of interest paid over time, potentially saving you money in the long run compared to other methods. While it may take longer to see individual debts paid off, it can be more cost-effective overall. It's suitable for those who are financially disciplined and want to minimize interest expenses. 5.3. Debt consolidation. Debt consolidation involves combining multiple debts into a single loan or line of credit. This can be done through a balance transfer credit card, a personal loan, or a home equity loan or line of credit. The main goal of debt consolidation is to simplify repayment by consolidating multiple payments into one, potentially lowering the interest rate and extending the repayment term. This can make it easier to manage debt and reduce monthly payments. However, it's essential to carefully consider the terms and fees associated with the consolidation loan, as well as your ability to repay the consolidated debt. Debt consolidation may not be suitable for everyone, so it's important to weigh the pros and cons and seek advice from a financial advisor if needed. 6. Increasing your income. Increasing your income can be a powerful way to improve your financial situation and pay off debt more quickly. Here are some strategies you can consider. 1. Side hustle. Take on a part-time job or start a side business to earn extra income outside of your regular job. This could include freelance work, consulting, tutoring, or selling handmade goods online. 2. Skill development. Invest in developing new skills or certifications that could lead to higher paying job opportunities or freelance gigs. Online courses, workshops, or certifications in areas like digital marketing, coding, or graphic design can be valuable assets. 3. Ask for a raise. If you've been performing well at your current job, consider asking for a raise or promotion. Prepare a compelling case highlighting your contributions to the company and the value you bring to your role. 4. Career change. Explore opportunities for career advancement or transitioning to a higher paying field. This could involve further education, networking, or seeking out mentors in your desired industry. 5. Passive income. Look into creating passive income streams, such as rental properties, investments in stocks or real estate investment trusts or REITs, or creating digital products like ebooks or online courses. 6. Monetize hobbies. Turn your hobbies or interests into income-generating activities. For example, if you enjoy photography, you could sell your photos online or offer photography services for events. 7. Rent out assets. Consider renting out assets you own, such as a spare room in your home through Airbnb, a parking space, or equipment you don't use frequently. 8. Participate in the sharing economy. Explore opportunities to earn money through sharing economy platforms like Uber, Lyft, TaskRabbit, or Airbnb. By diversifying your income streams and finding ways to increase your earning potential, you can create additional financial stability and accelerate your journey toward achieving your financial goals, including paying off debt. 7. Cutting expenses. Cutting expenses is a practical way to free up money for debt repayment and improve your overall financial health. Here are some strategies to consider. 1. Create a budget. Start by tracking your expenses and categorizing them into essential, e.g., housing, groceries, utilities, and non-essential, e.g., dining out, entertainment, categories. Use a budgeting tool or app to help you visualize your spending and identify areas where you can cut back. 2. Reduce discretionary spending. Look for ways to trim non-essential expenses, such as eating out less frequently, canceling unused subscriptions or memberships, and finding free or low-cost alternatives for entertainment and leisure activities. 3. Negotiate bills. Reach out to service providers such as cable, internet, or insurance companies to negotiate lower rates or shop around for better deals. You may be able to save money by bundling services or switching to a different provider. 4. Save on transportation. Consider carpooling, using public transportation, biking, or walking instead of driving to save on gas and maintenance costs. If you have multiple vehicles, evaluate whether you can downsize to one or consider more fuel-efficient options. 5. Cut utility costs. Implement energy-saving measures in your home, such as using programmable thermostats, switching to energy-efficient appliances, and reducing water usage. These actions can help lower utility bills over time. 6. Shop smart. Look for opportunities to save money on groceries by planning meals, using coupons, buying in bulk, and shopping at discount stores or farmers markets. Avoid impulse purchases and stick to your shopping list. 7. Review subscriptions and memberships. Regularly review your recurring subscriptions and memberships to determine if they're still necessary or if there are cheaper alternatives available. Canceling unused or unnecessary subscriptions can save you money each month. 8. DIY whenever possible. Instead of paying for services like home maintenance, landscaping, or car repairs, consider tackling these tasks yourself if you have the skills and resources to do so safely. DIY projects can save you money on labor costs. By taking a proactive approach to cutting expenses and making conscious, spending decisions, you can create more room in your budget to pay off debt and work towards achieving your financial goals. 8. Avoiding temptations and pitfalls. Avoiding temptations and pitfalls when managing debt is crucial for financial stability. Establish a budget that outlines your income and expenses, prioritizing spending on essentials. Recognize triggers that lead to overspending and develop strategies to avoid or cope with them. Practice delayed gratification by considering purchases carefully before making them. Limit access to credit cards or lines of credit to reduce the temptation to accumulate more debt. Seek out free or low-cost alternatives to activities that might tempt you to overspend. Surround yourself with supportive friends and family who can provide encouragement and accountability. Prioritize self-care activities to manage stress and emotional triggers that can lead to impulsive spending. Here are some effective tips to help avoid spending temptations and stay on track with your financial goals. 1. Make a budget and stick to it. Create a realistic budget that covers your essential expenses and allocates funds for savings and debt repayment. Having a clear plan for your money can help you resist impulsive purchases. 2. Avoid tempting situations. If you struggle with overspending in certain environments, such as malls or online shopping sites, try to limit your exposure to those situations or find alternative activities that don't involve spending money. 3. Use the 24-hour rule. Whenever you feel the urge to make an unnecessary purchase, implement the 24-hour rule. Wait at least 24 hours before making the purchase, and you may find that the temptation has passed. 4. Unsubscribe from promotional emails. Marketing emails and advertisements can create a sense of urgency and temptation to buy. Unsubscribe from promotional emails or use ad blockers to minimize these triggers. 5. Leave credit cards at home. Carrying cash instead of credit cards can make you more conscious of your spending and limit the temptation to overspend. 6. Identify emotional triggers. Emotional factors such as stress, boredom, or feeling unrewarded can lead to impulsive spending. Recognize your emotional triggers and find healthier coping mechanisms like exercise, hobbies, or talking to a friend. 7. Track your spending. Keep a record of your expenses to increase awareness of where your money is going. This can help you identify areas where you tend to overspend and make adjustments. 8. Set financial goals. Having clear financial goals, such as saving for a down payment, paying off debt, or building an emergency fund, can provide motivation to resist spending temptations and stay focused. 9. Find accountability. Share your financial goals with friends or family, or join a support group. Having an accountability partner can help you stay committed to your plans and resist temptations. 10. Practice gratitude. Cultivate a mindset of gratitude for what you already have. This can help reduce the desire for constant acquisition and make it easier to resist impulse purchases. Remember, avoiding spending temptations is a continuous process that it requires self-awareness, discipline, and a commitment to your financial well-being. Here are some tips to help avoid falling victim to scams. 1. Be wary of unsolicited calls, emails, or messages Asking for personal or financial information. Legitimate companies won't ask for sensitive data this way. 2. Don't click on links or attachments from unknown sources. They could contain malware or lead you to a phishing site designed to steal your information. 3. Research companies thoroughly before doing business with them. Check reviews, their website, and verify their physical address and phone number. 4. Be cautious of deals that seem too good to be true. Scammers often use this tactic to lure victims. 5. Never send money or provide financial information to someone you don't know and trust, especially if they request payment via wire transfer, gift cards, or cryptocurrency. 6. Don't feel pressured to act immediately on offers or opportunities. Scammers create a sense of urgency to prevent you from thinking it through. 7. Be skeptical of calls claiming to be from government agencies or companies stating there's an issue with your account that requires payment or personal information. 8. Monitor your financial accounts regularly for any unauthorized activity and report suspicious transactions immediately. 9. Use secure and trusted payment methods when making online purchases, and avoid paying with methods that are difficult to trace or recover funds from. 10. Trust your instincts. If something seems off or makes you uncomfortable, it's better to walk away than risk falling for a scam. Remember, scammers are constantly evolving their tactics, so it's important to stay vigilant and educate yourself on the latest scam trends. If you suspect you've been targeted by a scam, report it to the proper authorities immediately. 9. Building an emergency fund. Building an emergency fund is essential for financial stability and resilience. An emergency fund serves as a financial safety net, providing a cushion to cover unexpected expenses or income disruptions without relying on credit cards or loans. To build an emergency fund, 1. Set a savings goal. Determine how much you want to save in your emergency fund. Typically 3 to 6 months worth of living expenses. Adjust the goal based on your individual circumstances and financial obligations. 2. Create a budget. Review your income and expenses to identify areas where you can cut back and allocate funds towards savings. Consistently contribute a portion of your income to your emergency fund each month. 3. Automate savings. Set up automatic transfers from your checking account to your emergency fund to ensure consistent savings without the temptation to spend the money elsewhere. 4. Start small. Grow over time. If you're unable to save the full amount of your emergency fund right away, start with a smaller goal and gradually increase it over time as your financial situation improves. 5. Use windfalls wisely. Direct unexpected windfalls such as tax refunds, bonuses, or gifts towards your emergency fund to boost savings progress. 6. Prioritize high-interest debt. While building your emergency fund, continue making minimum payments on your debts, but prioritize high-interest debt to reduce interest costs over time. 7. Keep funds accessible. Store your emergency fund in a liquid and easily accessible account, such as a high-yield savings account or a money market account, to ensure you can access the funds quickly when needed. 8. Replenish after use. If you dip into your emergency fund for unexpected expenses, Prioritize replenishing the fund as soon as possible to maintain its intended purpose as a financial safety net. Building an emergency fund takes time and discipline, but having one in place provides peace of mind and financial security, allowing you to navigate unforeseen circumstances with confidence. 10. Staying motivated. Staying motivated on your financial journey is crucial for achieving your goals. Visualize the benefits of financial stability and remind yourself of the reasons why you're working towards them. Celebrate milestones along the way, no matter how small, and acknowledge your progress. Surround yourself with supportive friends and family who can encourage and hold you accountable. Set specific, achievable goals and track your progress regularly to stay motivated. Find inspiration from success stories or role models who have achieved similar financial goals. Lastly, remember that setbacks are part of the process, so be kind to yourself and stay focused on the bigger picture. Paying off debt can be a challenging and daunting task, but staying motivated is crucial to achieving your financial goals. Here are some tips to help you stay motivated to pay off debt. 1. Set clear and achievable goals. Break down your debt into smaller, more manageable goals. Celebrate each milestone as you achieve it and use it as motivation to keep going. 2. Create a visual reminder. Use a visual aid, such as a debt thermometer or a progress chart, to track your progress. Seeing your progress can provide a sense of accomplishment and motivate you to continue. 3. Automate your payments. Set up automatic payments or transfers to your debt accounts. This can help ensure that you consistently pay off your debt without having to remember to do it manually. 4. Find an accountability partner. Share your debt payoff goals with a friend or family member who can hold you accountable and encourage you along the way. 5. Remind yourself of the benefits. Focus on the long-term benefits of being debt-free, such as increased financial freedom, reduced stress, and the ability to save and invest more efficiently. 6. Cut expenses and increase income. Look for ways to reduce your expenses and increase your income. Allocating the extra money towards your debt can help you pay it off faster. 7. Use the debt snowball or avalanche method. Prioritize paying off your debts using either the debt snowball method, or paying off the smallest debt first, or the debt avalanche method, or paying off the debts with the highest interest rates first. 8. Celebrate small wins. Recognize and celebrate your progress, even if it's just a small step towards your overall goal. This can help maintain your motivation and prevent burnout. 9. Imagine your debt-free life. Visualize how you'll feel and what you'll be able to do once you're debt-free. This mental exercise can provide a powerful motivator to stay on track. 10. Be patient and persistent. Paying off debt can be a long and challenging process, but staying patient and persistent is key. Remind yourself that every payment brings you closer to your goal. Remember, staying motivated is essential, but it's also important to be realistic and not become discouraged if you encounter setbacks. Celebrate your progress, adjust your plan if necessary, and keep pushing forward towards a debt-free life. 11. Dealing with creditors. When dealing with creditors, communication and negotiation are key. If you're struggling to make payments, Reach out to your creditors as soon as possible to discuss your situation. Be honest about your financial difficulties and explain why you're unable to make payments as agreed. Ask if they offer any hardship programs or payment plans that could temporarily lower your payments or interest rates. Many creditors are willing to work with borrowers facing financial challenges, especially if it means they'll eventually receive payment. Keep thorough records of all communications with creditors, including dates, times, and names of representatives you speak with. Follow up any phone conversations with written confirmation of agreements made. If you're unable to negotiate a solution directly with your creditors, consider seeking assistance from a reputable credit counseling agency. They can help you explore options for managing your debt and negotiating with creditors on your behalf. Remember to stay proactive and take control of your financial situation. Ignoring creditors or avoiding communication will only make the situation worse in the long run. 12. Planning for the future. Planning for the future involves setting goals and creating a roadmap to achieve them. Start by identifying your long-term financial objectives, such as buying a home, saving for retirement, or funding your children's education. Break down these goals into smaller, manageable milestones. Next, assess your current financial situation, including income, expenses, assets, and debts. Create a budget to help you prioritize spending and saving in alignment with your goals. Consider working with a financial advisor to develop a comprehensive financial plan tailored to your needs and objectives. Invest in your future by saving and investing wisely. Maximize contributions to retirement accounts such as 401ks or IRAs and take advantage of employer matching contributions if available. Diversify your investment portfolio to mitigate risk and maximize returns over time. Protect yourself and your loved ones with adequate insurance coverage, including health insurance, life insurance, disability insurance, and property insurance. Review your coverage regularly to ensure it meets your evolving needs. Stay flexible and adaptable as life circumstances change. Continuously monitor your progress towards your goals and adjust your plan as needed. Regularly review and update your will, estate plan, and beneficiaries to reflect any major life events or changes in your financial situation. Lastly, cultivate a mindset of financial literacy and empowerment. Educate yourself about personal finance topics. Seek out opportunities for growth and learning, and make informed decisions that align with your values and priorities. By taking proactive steps to plan for the future, you can build financial security and create the life you envision for yourself and your family. 13. Conclusion. In conclusion, effectively managing debt requires a combination of strategies, including understanding your debt, creating a budget, and prioritizing repayment. By utilizing methods such as the snowball or avalanche methods, you can accelerate your debt payoff journey. Additionally, building an emergency fund, increasing your income, and cutting expenses are essential steps towards financial stability. It's crucial to stay motivated, communicate with creditors, and plan for the future by setting goals and creating a comprehensive financial plan. With dedication and perseverance, you can achieve financial freedom and create a brighter financial future for yourself. You have been listening to Debt: How to Quickly Get Out of Debt, written by Daniel Shore, narrated by Jacob Simmons.